All right, everybody. Welcome to AMA number 20. Sorry for the delay. I actually had a bit of a rough night. I need to get a new chair for my desk. It's killing me. Anyways, without further ado, let's start right away. So, as usual, I don't think there's anybody new here. I think Ina, I don't know if you've joined these before. Usually I do like a bit of a monologue for about 30, 40 minutes. I think this time is going to be about 30 minutes, maybe less. I don't have a lot to share other than what I've already shared on Discord. So if you've been keeping up with the chat, there's a couple of new things that I don't know if I discussed them with you guys, and I want to discuss them here. It's all about trying to figure out what's going to happen. And broadly speaking, it's about trying to figure out what's going to happen when the tools that we usually use here to determine what's going to happen, are not exactly working to specification. So anybody who was around since, at least 12 months, if you were around last year, you know that we use these lines, these liquidity lines, just to recap what they are. We use these liquidity lines to pretty much up until February, I would say, these two liquidity lines. Let me hide this because we were not using red. We were not using Japan. We were just using central bank liquidity. And central bank liquidity pretty much helped us nail every high and low. Going back to the start of this bull market, I said in a few AMAs, I think you might remember this, Perry. I said I don't think liquidity is going to be this good going forward simply because it was that good. It was amazing. Um, Central bank liquidity, which is the blue line you see here, you move that forward by 84 days. That helped us nail pretty much every move. And I was late to discover this, to be honest. I was not using it in 2024, for instance. I was using third-party work, mostly Raoul at GMI, around this time in May and April of 2025. Then later in July, I was doing my own research on this topic, and I discovered that, well, they were using M2 and something proprietary called they have the GMI Financial Conditions Index, something like that. That's what they call it, and they claim that that's even better than M2. Whatever it is they're using, it wasn't really working so well. So I decided to do my own research on this, and this is when I discovered central bank liquidity. Central bank liquidity is another form of liquidity. And before you ask, most of these work. Like M2 works, central bank liquidity works. If you use something like the Japanese, like the price of the yen to the US dollar, that actually works too. This is not a liquidity metric. You can just use a basket of currency. You can use a Dixie if you want. You move that forward 3 months, and that predicts roughly the price of Bitcoin by about 3 months. Now, I landed on this one, central bank liquidity, simply because on my statistical, it's called Granger causation analysis. And on my Granger causation analysis, I found this one, the blue line you're seeing here, central bank liquidity, to be quite solid. I also discovered and decided not to use it because I didn't think the metric was broad enough. But I discovered, this will be relevant in just a minute, I discovered that Japanese M2, just Japanese M2, was actually the best predictor liquidity metric for predicting the price of Bitcoin. And I don't mean for 2025, I mean broadly speaking, it was the best, the single best measurement you can use. Now, Japanese M2 breaks down into two components: the movement of M2, so how money supply changes in Japan. That would be 10-20% of Japanese M2. Japanese M2 is dominated by the price of the yen to the US dollar. So it's basically you're using the price of the yen. And before you ask, yes, I tried saying, okay, if the price of the yen dominates this metric, then I'm just going to strip out the M2 component, just looking at how much is 1 yen worth in dollar terms. That's actually worse. It's actually useful to add the money supply metrics. That is the single best predictor for Bitcoin prices. The problem is I don't like it because it's not broad-based enough. It doesn't take into account any other currencies, any other central bank balance sheets. I just don't like to rely on it too much. I'm using it now. Do you know this if you're following the Discord? I'm using it now because it is working. I'm probably going to go back to not relying on it so much once we get out of crypto winter. I guess for the duration of this bear market, we're going to be using Japanese M2. But this is a remarkable metric. Part of the reason I was not using Japanese M2 and I was using them interchangeably, Japan. I was for a while I was using Asian liquidity. That stopped working since. Perry, you probably remember how we went over that. that the Asian liquidity was basically China and Japan. That broke down at about October 2025. Again, all of these are good. And over time, if you look at it over a multi-year horizon, all of these will be useful, including M2, although M2 is my least favorite because it contains a lot of US. It's dominated by US numbers, which is the largest economy, at least in terms monetarily speaking. It is the largest economy in the world, financially speaking. And those have no predictive power over the price of Bitcoin. So Fed balance sheet, no predictive power. M2, like US M2, no predictive power. You're better off stripping those away. You don't need them. And also, the US M2 just rose over time. So you're adding bullish bias to your prediction. You don't need that. I don't want this to be a dissertation on how liquidity works, suffice to say. And I think a lot of people miss this. In terms of how these liquidity measurements work, it's important to distinguish between two statistical concepts. One is R2, which is basically whether or not it predicts not only the timing of something, but also how much it will move. That's R2. And then there's correlation. Correlation just simply means, do these two move together or not? Regardless of whether or not they mirror each other's moves. By that, I mean, does Bitcoin consistently move up a certain percentage when M2 moves a certain percentage? No, they don't. Actually, R2 and all of these is horrible. What that means in layman terms is these liquidity M2 metrics, these macro models do not predict price. They predict time, not price. They are highly correlated. That does not mean if we see a surge in liquidity as we're seeing here, and it looks like it's following it. Like if you look at this move, this is the April 2025 July 14 top. If you look at this, it looks like, yeah, they're perfect match between liquidity and the price of Bitcoin. We're actually fitting these charts to make them fit. So this is curve fitting, and it's at its finest. If we go forward to what we're seeing now, you can notice, and this is what I want to discuss mostly now, you can actually see that this is it's playing out exactly as I just described. So in other words, and liquidity, this is central bank liquidity in this case, it predicts when Bitcoin will rally and when Bitcoin will be falling, but not by how much. Now, it's not normally as egregious as we're seeing here, where we have liquidity absolutely surging. This is mostly because the dollar has been crashing. And Bitcoin follows it from a timing perspective, but extremely weak. It's not normally like this. So usually you can use liquidity to get a sense of how much Bitcoin will move. But it just gives you an idea. There's no price prediction here. This is not like, well, if liquidity is going up by 10%, by the way, some people claim that doesn't work. You can't make statements such as if liquidity will move up by 10%, and I've seen people do that. That's why I'm making this point. If liquidity moves up by 10%, Bitcoin will rally 50%. Nope, that's not how it works. You can do the average if you want. You can say things like, when liquidity moves up 10%, Bitcoin will usually move up 50%. That's all over the place. Standard deviation on that is 100%. So if liquidity moves up 10%, Bitcoin can move up anywhere between 5% and 100%. There's no predictive power there. It does not tell you how much prices will move. And if you know me, if you've been following me for some time, you will know I am still trying to predict prices using other tools. And I've been frustrated by the fact that, yeah, actually these timing tools are phenomenal, but they don't work to predict price. Again, not normally as egregious as we're seeing here. Notice that the blue line here is making a new high as it heads into this May top. We'll discuss it in a moment. It's making a higher high over this September 2025 top. Normally, that means Bitcoin should at least get close to a new all-time high or close to its high. So normally, yeah, there is some predictive power there. But you can see here that this is why it's important to know what the rules are and, strictly speaking, what these indicators can do and what they cannot do. I don't know if I'm making any sense. What I'm trying to say here is, yes, normally you can use liquidity to get a sense of how big the move will be, but strictly speaking, you cannot. And since the February low that we made here on February 5, which is within a week of what liquidity predicted, that has come into play. In other words, yeah, Bitcoin did bottom in February, exactly as liquidity suggested. It didn't move up at all. Is that shocking? Is that surprising? No, we know that this is how these models work. In fact, if we go here to all three macro models that I like to use, notice that we have the 10-year rate here, we have T-bill supply, and we also have central bank liquidity. All three said Bitcoin's going to bottom in February. And all three have impressive moves following this February low. Impressive moves, which can lead us to think, and in fact, I'm not going to apologize for saying, hey, this looks very bullish. It does, because normally, yes, these macro tools can give you a sense of how much prices will move, but strictly speaking, they don't. Strictly speaking, what we're seeing in Bitcoin right now is exactly, it is rather within what these models, within the margin of error of these models. Bitcoin has barely moved since the February low, but it did make a low in February, exactly as suggested by the macro models. What are the macro models saying now? Well, there's two tops. Boom, let me clone this. There's two potential tops. One suggested by the bond market, and another one suggested by, oh no, I don't want this. We don't need this text. Bye. And we don't need this text either. Well, we can leave that. So it's roughly around May 4. It's actually the week. This is a weekly chart. So roughly around the week of May 4, 2026. So it's coming up in 2 or 3 weeks. So 2 3 weeks. I say 2 3 because 2 weeks from now is when the bond market says Bitcoin's going to top out. And then if you look at central bank liquidity, which is better, has a lower margin of error, it looks forward the least, but it is the most accurate in terms of when the Bitcoin high will actually land. And that one is May 4. It's a week of May 4, strictly speaking. I think it's May 9. I think it's the exact date forecasted by liquidity, but it's close enough. And notice that one thing I was noticing the other day is that even though, yes, I do believe that the news out of the Middle East, the Iran war, has distorted Bitcoin price action, actually the correlation between bonds and liquidity, so the black and the blue lines, not that it matters, I don't trade any of these, but it has held up pretty well. Notice that since the start of the year, bonds were saying that liquidity first, Bitcoin second, will rally into a high around late April and then make a low sometime in late June or early July. The war started after this. In fact, this sell-off that you're seeing here in liquidity, this is the dollar rallying because the Iran war started. And notice that when does the dollar make its high and starts heading lower again? Around the time, around late June, early July, when accounting for these offsets. But this is not real time. This is forward looking. But it's falling. It's making this bottom exactly when the bond market predicted a year ago. And there's no way the bond market was pricing in this war. So these indicators are remarkably accurate. So in other words, the mechanism that broke here, and I'm not entirely sure it's because the macro was broken. Actually, I'm pretty sure. I think it has more to do with cycles. We're going to discuss that probably in a moment. So bonds predicted what the dollar would do 10 months ahead of time. And then that should in turn predict what Bitcoin is going to do 3 months ahead of time. And again, from a timing perspective, it's holding up. So the correlation is holding up. Why is that important? It's important because we're recording this on April 15, and both the bond market and the and central bank liquidity, so that the dollar exchange rate against a basket of currencies, weighted by the balance sheets of their own central bank. So this is like think of central bank liquidity as a different type. So I have a different type of dollar index. It's not trade weighted or anything. It's central bank balance sheet weighted. Pretty good metric. I like it quite a bit. And what both are saying and agreeing on is there's a high coming up in May. There's a high coming up in May. Now, I'm going to show you in a moment if you want the new Astro models that I'm using. They have actually been working day and night on these for already about a couple of months, and they're getting pretty good now. And it agrees. So the model that I used to predict Bitcoin's 80-day cycle, which I call a composite model now, so it's not just one astrological technique, it's actually several, and I combine them into a single unified model, and they all agree. The high should be around May 15. So they agree with the macro. And if you've been following me for some time, that's what I like to see. I don't rely just on the planetary stuff by itself. I like to rely on macro more, and I use the planetary things to fine-tune the dates. I want to see, in other words, the planets agree with the macro. If the macro disagrees with the planets, I usually go with the macro, because macro is things that directly relate to the price of Bitcoin. What we're tracking here broadly speaking, is the supply of dollars, the dollar interest rate, and how much public debt, dollar public debt, floats on the markets. Those are the things we're tracking. It's strictly monetary stuff, and those monetary things predict the price of Bitcoin with remarkable accuracy. Much more so, I would say, than the planetary stuff for one simple reason. Planets can invert. In other words, no aspect, no planetary configuration can tell you whether something will be a high or a low for Bitcoin, but macro does. Macro can say if the macro models are making a peak around May, you can expect a high in May, not a low, not an inversion, none of that. They're forward looking, which is amazing. We can see 3 months ahead of time at least. With the bond market, we can see 13 months ahead of time. And they never invert. So Bitcoin follows the shape of those assets, roughly speaking. But, what happened since February notwithstanding. I mean, this was not a failure. I call it a failure. They failed to predict price in a spectacular fashion, but they did not fail to predict the path of price, so the timing of the highs and the lows. So that's important. So we have this low. We had this low in February. We got the low in February. Notice that the orange line, this is Bitcoin, in case it's not clear. Not really. It's kind of like trying to catch up to these indicators. It won't. I'm not here predicting. Don't worry, guys. In the next 2 weeks, Bitcoin catches up to central bank liquidity, and it's going to go to 100,000. No, I'm not saying that. I'm saying we have another 2 to 3 weeks to rally still. Then we head lower. Now, can we use, like I said, going back to this Japanese M2 versus central bank liquidity, can we use liquidity to forecast the price of Bitcoin, the actual price level? Strictly speaking, like I said, no, we cannot. We can't do that. However, we could try. We can still try. And so this is why I started using Japanese M2, JPM2. I'm using this now because if I zoom in here, okay, it's clear that since this March 17 top, Bitcoin is not really following central bank liquidity, at least in terms of price. In terms of timing, I believe you should not be shocked to see that Bitcoin actually makes its high around May 9, because that's what the timing says. And I say around May 9, it could be April 27. There is about up to 2 weeks of margin of error here. This is why I don't think this is a top. So it will be too early for this top. It can happen. It has happened before. I've seen liquidity be off by up to a month, but it's quite rare. So not something you should bet on. What else? Where was I going with that? See, this is what happens when you're sleep deprived is you need your coffee. Perry, promise I'll get to your questions when I'm done here. Anyways, so can we use liquidity to predict the price of Bitcoin? As I was saying, no, we cannot. But we still try if we find something that fits. And again, if you were following the Discord, you know where I'm going with this. It looks like Bitcoin has been following Japanese M2 much more closely than central bank liquidity. In fact, what Japanese M2 was telling us is expect this flat 2 months, so sideways 2 months between February and April. That's what happened. Now, part of the reason that led me to dismiss, other than the fact that I don't find JPM2 to be broad enough, part of the reason I dismissed it has to do with this price action, this surge. I mean, this actually happened within, so it's the 21st, it's like 5 days. So in 5 days, what Japanese M2 seems to be suggesting is this surge in the price of Bitcoin. That doesn't make any sense because markets don't really behave this way. Then a crash, and then another surge. This doesn't make any sense. In fact, I'm here saying Bitcoin's not going to do this. It probably makes a high either on April 21st or it makes a high on May 9, around that time. I'm here to make the case May 9 is when the high will take place, but I'll take a brief detour before I do that. Why is Japanese M2 doing this? Yen intervention. So the Japanese, in coordination with the US government, the Japanese started actually selling dollars aggressively at this time, 3 months. So 3 months ago, they were starting to do this. They did this twice, this coordinated effort to make the price of the dollar go down. And you can see these twin peaks here. This is why. So this is extreme manipulation in the price of the Japanese yen that you're seeing here, which is why I'm not entirely sure it will follow exactly what you're seeing on this chart. But I want to take the pattern that we saw between February and April and trying to extrapolate it into this April-May potential high. Potential. Allegedly, it's going to be a top. Now, it's probably going to top out around that time. So it's important to notice that, yeah, the price action sort of followed Japanese M2, but keep in mind, if I hide all these, and hiding these, if I hide the price action of Bitcoin and I hide central bank liquidity, when is the low according to Japanese M2? Well, it's in April. It's not in February. In fact, out of the four macro indicators that I'm using, Japanese M2, central bank liquidity, T-bill supply, and 10-year rate, out of all those four, the only one that actually had a low in April was Japanese M2. The other three said February. My own forecasting models using the planet said February. So that's why I leaned heavily on February. I said to myself, there's no way this one lonely indicator will point to the low. It's probably going to be in February. It's 3 out of 4. When we look at the macro, if I added the planetary stuff, 3 different models, all three said February. So if you count those as separate models, that's seven models. One of them said April, and the other 6 said, and by the way, when I'm sleep deprived, I do the math wrong, so maybe I got this wrong. But anyways, bear with me. You're gonna have to bear with me today, you guys. But the low, according to 6 out of those 7 models, was in February. So I went, okay, the low is gonna be in February. It was. I was right to do that. The low was in February. Let's use central bank liquidity as a proxy for what all the other models are doing. All the macro models, all the astro models are doing, because they are like the macro. These 3 macro models, the green line, the blue line, and the black line, plus 3 different planetary models, all say May, and all said February low. We got that. The problem is Bitcoin actually kind of followed Japan. So both are useful. This is where I'm landing on as of this week. Like, both are useful. We should not have ignored the macro models because they said February was the low, and February was indeed when the bottom was. However, Japanese M2 warned the price action was going to be weak, muted, pretty bad, lackluster, range bound. That's what we've seen. What warned us of this? As far as my models are concerned, the only thing that warned us of this is Japanese M2, which is, I just said a while back, Japanese M2 is actually the best single predictor of Bitcoin prices that I have seen in terms of macro. It is the best. So you cannot ever ignore it, especially when there's such divergence between all your macro models and the single best one. Use all of them to form your opinion. But here's what happened. Here's where I'm landing on, again, as of yesterday. February was indeed the low. So we're right to use the macro models. But Japanese M2 told us what prices would do. So you use both. And now you're seeing the same divergence. So now we're seeing Japanese M2 say, hey, the high is going to be in April. Whereas all the other macro models are saying, hey, the high is going to be in May. You see how it rhymes with what happened in February? Back in February, all macro models said the bottom is in February. Japanese M2 said the low is going to be in April 7. The low was in February, but price action kind of followed Japan. If the same thing happens now, prices will kind of follow Japan. In other words, we're not going to get this explosive rally implied by central bank liquidity, but it's likely that the high will line up with the macro models. In other words, it's going to be in May. It's not going to be in April. Once again, as was the case between February and April, Japan is the only one, Japanese M2 is the only one saying the high is going to take place on April 21st. All the other models are saying, all other 6 models, so I'm counting the Astro stuff too, all other 6 models are saying the high is in May. So I'm just going to go, hey, I think this history is going to repeat here, and the high will prove to be in May. So we have some time. Am I super convinced of this? No, not really. I would not even be surprised to see the high in April 21. Couple reasons why. There is also the legacy that I still use, the legacy model. That is mostly a volatility model, which you can find on the Discord channel. It's under the Forecast 2026 page. You can see a PDF there that was put together by Perry, and it highlights April 20th as a major top. The problem with that is it can invert. And the problem with that is, based on my testing, that model is extremely good at predicting volatility, not necessarily turning points. But there's that data point. So April 20th has been highlighted as a major reversal. Maybe not a high, could be a low, but it's a major reversal. That's one data point. That's why we cannot fully ignore April 20. The other reason we cannot fully ignore April 20 is that's when the ceasefire ends. And Trump is already amassing the armada around and around. So if they don't reach any type of deal, then maybe hostilities resume around on or around April 20th, and Bitcoin crashes on the news. It could also be that Bitcoin crashes on the news because war broke out again, and then there's some sense of negotiations that take place shortly thereafter, which would explain what Japanese M2 is doing here, highlighting a double top. But again, I want to be clear, I don't think we're going to see this double top. Rather, I think Bitcoin just proceeds higher. Let me bring Bitcoin back up here. I think it proceeds higher, generally speaking, into May, with some volatility along the way on April 20th, but the final top should be May. And the reason for that, I hope, was clear. The reason I think the high is in May is because out of the 7 models that I'm using, 6 of them, once again, as was the case in February, are saying that the high is going to be in May. Now, how much prices are going to move? Not much. So if you're not in this, like I said on the Discord yesterday, if you're not in this trade already, this is not a buy recommendation. Not at all. By the way, I don't do buy recommendations here. This is all free. I'm not allowed to do this. But even if I could, I would not be telling you to buy right now. Anybody who follows me from Weiss knows we're already in this trade. We bought months ago. We're not getting in now. This is a time to start divesting. Why? Because we're approaching these 2 dates. I hope I'm making sense here. I'm not ignoring April 20th. I'm saying I think the final top, which will be a 320-day cycle top, happens in May, doesn't happen in April. But April should still be significant for some reason. And we can already see that Bitcoin's price action is lackluster. Stock market is at new all-time highs, I believe, as of a couple hours ago. Bitcoin is unable to break above 76K. 76K is a technical level, in my opinion. Feel free to disagree. I think, Ina, you might disagree with that. That's great, actually. This is just my own analysis. Does not show. I actually have a high for April 14th on a short-term 20-day cycle model. However, that same model is saying, yeah, sure, you can take a pause here on April 20th, sorry, April 14th, but it should continue higher into May. That's what my models are, technically speaking, showing. I don't bother discussing 20-day cycles in these discussions or in the Discord or anywhere else because these are short-term moves. So I can see Bitcoin pulling back here for a few days, but that's it. It will be just a few days. The final high, I stand by that, should be May. And the reason for that is it looked in February and March, it looked like the macro was no longer leading Bitcoin. It looked a little broken. And it turns out it took a beating. These macro models took a beating here, but they're still working. They're still very much relevant. And they will continue to be. Like I said last year, I remember saying this a few times, what we're seeing here should not be entirely unexpected. Macro was working extremely well from 2022, late 2022 through 2025. It was working extremely well. And I know because I've done all the tests, I've tested these out, back tested these indicators. And I know sometimes the correlation can seem to break for a while, for a little bit. And so we should not have been terribly surprised to see this. And the war was a perfect catalyst for breaking this near perfect correlation and making it not so perfect. Over the past few months, this will change again. The correlation between liquidity, macro, broadly speaking, and Bitcoin likely resumes to what it was between 2022 and 2025 once we hit bottom on the 4-year cycle on Bitcoin. We'll discuss that if you want later. But I'm thinking that as long as crypto winter is in play, as long as technically we are in a 4-year cycle correction, macro will tell us when the highs and the lows will take place, but macro will probably dramatically overstate the moves. That's what we saw in February, dramatically overstated the moves. And again, if you're following me at Wise, you know that we've been on this trade for a while. I have been on this trade for a while, and I don't like this trade. I hate it. I wish I was in cash. I'm not. I actually started buying shortly after the Real Vision conference, which took place in late January. I met some of you guys in there. And that's when I started buying. I bought the bulk of Bitcoin around 80 to 75 underwater. Whole thing is underwater. I hedge, I can do this. I'm a big dude. I've been doing this long enough that I know what I'm getting into. But I don't like this trade. I thought it was going to be better. That's me saying, yeah. I mean, I'm using timing indicators to predict price moves, and sure, the price move did sort of take place, but it was nowhere near as exciting as I thought it was going to be. So I'll admit to that. Right now, what I'm doing personally is simply managing my positions. I've already exited out of of about 15% of my position. Another third of my position is hedged at 70K, and I'm going to be selling out at 80K. And then the other 2/3 of my position will see, because I'm still giving this market enough time. I think it still has enough time to have a bit of a move here. So usually when these moves end, when these cycle moves end, you get the most price action, you get the most price movement within the last few days. So I'm still thinking we may get an explosive rally soon. It will be very short-lived. It will last 2 to 3 days, and that's when I plan on exiting most of my positions. As far as I'm concerned, this is just personally my own P&L. I haven't made nearly enough on this trade, on this rally, to justify the exiting more than a third of my. It's just not justified. If Bitcoin gets back into the range now, it's 76K is the top, and it goes back to 60K. I'll keep what I have. It's fully hedged. It is structured. It's an option structure set up in such a way that I can wait months to get paid. I'm not going to lose much sleep over it. All right, that was the dissertation. Let me sip some coffee, and I'll get to your questions. Unless I didn't touch on anything, Perry, I'm going to get to through your stuff. Any comments on other assets, oil, S&P metals? Oh, Perry, we're going to go discuss the other markets. Absolutely. I mean, if there was a time to discuss macro assets, it will be now, because I think the stock market in particular is a little crazy. So yes, we're going to get to that. But let's just get through the bulk of crypto, and then we'll go into macro. Metals, oil, all of that good stuff. Yeah, absolutely. I actually do want to discuss. Because as you know, now that I've developed this framework for predicting assets using planets, I'm not just limiting myself to crypto anymore. I'm doing everything. I'm doing the NASDAQ, I'm doing the S&P, the dollar index, 10-year rates, 10-year bonds. What else? I'm tracking the Chinese stock market too, because reasons. I don't think I'm ever going to trade that. I invest in Chinese stocks. I think they're extremely undervalued. Anybody out there who wants a long-term investment thesis, buy China. China is stupid cheap right now. Stupid cheap. It's like PEs of 10 to 20, when equivalent companies in the United States are trading for 50, 60, 70 times earnings. Tesla's 200 times earnings. And I've had some Chinese small cap EV companies that run circles around Tesla, in my opinion. Anyways, I don't want to digress too much on that. All right, let me get to your questions. So Perry's saying the Japanese M2 seems somewhat minor and distant. Do you know why economically that's the highest correlation? I have no idea, Perry. I've one thought on this topic. I've thought about, why is Japan so important? Why is the price of the yen so important to predict the price of Bitcoin? And it's not just that. I don't know if you guys remember. Let me show you this. Let me show you, because I don't remember exactly what was happening at the time, but this was shocking to me, and it's not the first time I've seen it. Anybody who's old enough to have been trading during the Fukushima incident, you know what happened to the U.S. stock market when Fukushima took place. Massive crash. The U.S. stock market crashed because there was a tsunami in Japan. It's kind of counterintuitive. That's the first time I came into contact with this idea that Japan is a massive financial center for the world. Japan has had rates near zero longer than any other developed country in the world. So they act as a funding mechanism for the rest of the world. Traders all over the world borrow yen, buy dollars, and then they will go and buy other assets. So whenever there's a shock to Japan that makes Japanese investors sell assets and bid up the yen, there's a global margin call that takes place, and all assets crashed. Sorry. Last time that happened was actually in 2024. Let me hide all these liquidity things. In 2024, in August.
August 5th, yeah.
We had this crash. And what was this crash? It was something related to the yen. I don't remember exactly. It was a carry trade unwind.
It was a yen carry trade. Oh, wow.
I know. I remember, but I don't remember what caused it. Back then, we knew what was causing it, but I don't remember what did it. But this is what Japan will do. When the yen surges, markets crash. And this is just a thing that's been happening for quite some time, actually. So Japan is very important. There's another reason. Anybody who follows, I don't know if you guys follow this guy. He's kind of a doomer of sorts, but he's an extremely good analyst, very knowledgeable. Jeff Snyder, he's the Eurodollar University guy. And he's the one who has always pointed out, he knows that Japan is extremely important. Like he understands the plumbing of the financial system better than most people. And he's always said that the thing about Japan is that it is the supplier of dollars for Asia, particularly China. Where's the economic center of gravity right now? I believe it's in Asia. It's not really in the West anymore. It's in Asia. Who supplies dollars to Asian economies? Japan does. So you see how Japan plays a key role in the euro dollar system. Euro dollar is offshore dollar system, offshore dollar credit system. Japan is the center of that. This is why I believe the yen exchange rate and Japan specifically is so important for not just for Bitcoin, but for global assets. It clearly plays a prominent role, much more so than the euro, for example. Most of what you're seeing here, no, this is not this is the blue line. Most of what you're seeing on this blue line, this is mostly the dollar losing value against the euro. Mostly the dollar losing value against the euro. But the euro doesn't really, European economy is not that important unless you're in Europe. I used to be in Europe a few months ago. It was very important what's happening there. But if you're outside of Europe, what happens within Europe, irrelevant for the most part. And so what you're seeing here is mostly other currencies, mostly pound and euro, moving up against the dollar, whereas Japan is in a nightmare of their own. And so, yeah, there was some movement in the end. It necessitated intervention by the authorities. And this time, Scott Bessent got involved. I don't know if it was the first yen intervention or the second yen intervention. That's when even the U.S. Treasury got involved in this intervention. It was massive. And notice that Japanese yen kept falling. So it was not enough. It never is. When they step in, they sell billions of dollars in a matter of minutes in dollars to try and suppress the value of the dollar, and it doesn't work. It never works. So yeah, Japan is massive. Japan is very important still, and it's something that most people tend to overlook. There is one guy who I strongly recommend you follow, Weston Nakamura. He is a U.S. Japanese trader. He lives in Tokyo now, but he's American, I think. English is flawless. I only speak a little bit of Japanese. And he's the one who covers this most of the time. And even when this war started and we could see market disruptions, Weston was the first one. His Substack, I think is Across the Spread. Very well worth a read. He tends to write very long, very, very long issues, but they're very well worth reading because he has the finger on the pulse of what's happening in Asia and particularly in Japan. And he wrote an article when the war broke out showing how is actually the Japanese getting scared. Mostly that was the transmission mechanism between what was happening in the Middle East and global markets. It ran through Japan. It had a lot to do with how the Nikkei was trading. I think it's still true today, but he hasn't posted in a couple of months. He's kind of like me with his social media. It's like on and off. Like he obviously has other priorities. But whenever he posts, he's very well worth reading. Japan still holds most of the treasuries.
Can you tell Perry to paste the link for that guy? Okay, here it is. It's already here. Thanks, Perry.
Yeah, Perry's awesome. Thank you, Perry. Yeah, Western. I think Perry, I've mentioned him before. And he's also an extremely. He's not macro, not necessarily. He's definitely not into the astro voodoo. He's not a cycles guy. He's an extremely sharp trader. He looks at intraday moves. He can explain why the Nasdaq is doing what it's doing based on pivot points on the Nikkei or the Japanese yen. He understands very well the link between Japan and the global economy, and it's still something that people ignore. And I've never been to Japan. I've been to Asia twice, so I have a hard time grasping how big of an economic center of gravity Japan is. But it is. It clearly is. If you've been trading for longer than a decade, you understand this. What happened in 2024 in August, that was like a mini version of Fukushima. And actually going back, I saw other cases when this took place. Japan has been providing liquidity to the world for decades at this point. So they're extremely, extremely important, which is why Japanese M2 by itself is something to keep in mind whenever you're forecasting the price of Bitcoin. I don't know if I discussed this divergence with you all in an AMA between Japanese M2 and central bank liquidity. I do know that for those of you who follow me at Weiss, on February 19, I published an issue that was all about this divergence. And I didn't want to beat the drum on that too much. I didn't want to pound the table on that too much because I was like, this is confusing. Like I'm using two liquidity metrics. They both have the same displacement. They disagree with one another. I don't know if I should lean on this too much because people are going to say, hey, I'm confused. What's your outlook? Well, turns out I was confused too because divergence between central bank liquidity and Japanese M2 doesn't usually happen. It's very rare. I think they'll realign again at some point, but it's quite rare. Just to give you, and by the way, I based this analysis on statistics, not on gut feeling. When I say Japan M2 leads is the strongest leading indicator for Bitcoin, I have the numbers. I don't have them in front of me, but I've seen the numbers and I was impressed. This is even better than M2. And long-term M2 is actually pretty good. Global M2. Japan M2 is better. And look at this. Just one example of how strong it was. 2021, you have central bank liquidity, and by the way, all other liquidity metrics, just nonstop rallying until the March of 2022. Actually, this one was early. Other Global M2 topped in June of 2022. This one topped in March of 2022. When did Japan M2 top? A year earlier, in March of 2021. Look what Bitcoin did since. This is how strong Japan is by itself. Japan topped out March of 21. Bitcoin made a sharp high in March of 21, and you can argue it never recovered from that. And Japan M2, if you zoom into the 2021 price action, sort of did predict what Bitcoin would do next. Remember, there can be some deviation. Remember, these are timing tools. They do not predict actual price. But what was Japan M2 telling us in 2021? Well, it was saying you have two highs. You have one major high here. This is the top around March 30th, 2022. The actual high is April 14th. You're going to have a crash. No other liquidity metrics show this crash. You're going to have a crash. The low is going to be in June 21. You can see how this was indeed the low, June 22. It was retested. That's not shown by liquidity, but that's okay. That's how these two interact with one another. It retested the low in July 21, and then Japanese M2 said weak rally into November, I believe October 26th. The high is in November. So remarkable. And I've looked at other macro indicators. This is the only one that was saying this. I believe bonds were sort of alluding to this to this taking place, but it was really Japanese M2 that gave us the full picture for 2021. And once again, you can see here in 21, you can see what happened now in 26 in reverse. In other words, Japanese M2 is saying weak rally. We actually got a pretty decent rally in the price of Bitcoin within these 2 dates. But the dates were flawless. They were perfect, almost perfectly aligned, which is why I'm saying same thing happens now. High in May. Anyways, I digress. Japan is Asia's local petrol station is for filling up on USD. Yeah, that's exactly what it is, Perry. It is a supplier of dollars. The dollar is a product too, by the way. This is why I've always hated this idea of Trump saying, oh, they're taking advantage of us. No, they're not. You're paying your own currency. You print it out of thin air. What are you talking about? Who's taking advantage of you? You're paying in a worthless piece of paper that you create out of thin air. It's not even paper. It's just digits on the screen. This is how you afford everything. You want to get rid of the dollar? Go ahead. You're going to have to start paying for your own stuff, actually trading for it with something that is not something you create magically out of thin air. So the dollar is a product, is what I'm trying to say. So the United States does not have a trade deficit when you include the dollar as a product. If the dollar is a product manufactured in America and used by the rest of the world, then America is always balanced in terms of trade, always balanced. And so, yeah, you can excuse Trump is not an economist, so you can excuse him for not understanding this. But some of his top economic advisors who argue for this, they're insane. These people are whatever. They're not smart. I want to call out Peter Navarro. I think he even wrote a book on this, on the tariff. It's nonsense, complete nonsense, filled with inaccuracies. And these guys call themselves economists. And this guy calls a PhD, I think. It's ridiculous. Out of what university, I don't know, but I think it's pretty prestigious. So absolutely ridiculous, embarrassing. Anyways, R2 means R squared, correct? I used to do a lot of curve fitting today. Yeah, Perry, R2 is R squared. It's error. And I actually didn't know this because I don't remember because I studied this 15 years ago already, 16 years ago since I took my last statistics course. And R2, Claude was kind enough to remind me, shout out to Anthropic, awesome product. It was kind enough to remind me that R2, when R2 is strong, it means the model is not only accurate in terms of timing, but also price. Price for us. So the y-axis, it's not just the x-axis, it's also the y-axis that is being forecasted by your model. R2 on the macro models is quite bad, actually. It's not good. It's almost non-existent. It's one of those metrics you ignore. But I will say this. Why am I so excited about the Astro models? Some of the Astro models have very good R2, like 60, 70%, which means some of the Astro models that I have not only predict time, they predict price too. And no, I'm not done the work on that. So I will need to reverse engineer. I will need to go from the R2 of the Astro model back into Bitcoin price. I need to reverse engineer that. Haven't done that work yet, but I want to once R2 crosses a certain threshold. But hopefully in this session, I can show you some of these models, some of these Astro models, not only predict time, they predict price too in a shockingly accurate way, shockingly accurate. And mostly this is the long-term models. So the long-term models, anybody who knows astrology knows this to be true. It's easier to predict long-term trends than what's going to happen day to day, month to month, even year to year. But the long-term stuff plays out almost as if it was meant to happen. The long-term stuff. When I've done work isolating long-term frequencies on any market, usually what I see, there are some exceptions, but usually the models that predict multi-year cycles are extremely accurate in terms of timing. I'm talking correlations above 90%. Sometimes I've seen them for Bitcoin, I think 99% for the year, for the 4-year cycle. So 99% correlation. That means the timing is near perfect. And this is on testing. This is not on data that the models have seen at all. I do not train the models on this data. I test it on this data. 99% correlation in some cases. But even in the stock market, 90% correlation. And usually when correlations are that high, R2 is also high. Not as high, 50, 60%. That is remarkable, though. That means the planets are not only predicting the timing of the highs and lows, they're actually predicting the price itself. But again, I'm not done work on that. I've just noticed that R2 is strong in some cases. I will also point out that in many cases, in most cases, the most accurate models have R2s approaching zero. It's like 0.001, meaning there's no predicting price with these models, and they're still good. They're still very useful. Anyways, moving on. So, comment, says Perry. I think we all get visually misled on the charts, thinking that liquidity macros are showing price levels, even though you've repeatedly said they're just directional timing. Yeah, Perry, that's key. That is key. And I think most people have missed that. Shout out to Michael Howell. Michael Howell is like the grandfather of liquidity analysis. And I've seen him state on many podcasts, he said, oh, Bitcoin reacts like 5x to liquidity and gold is only 1.5x. What he's talking price. And I think, by the way, he's amazing. He's an amazing, one of the best analysts in the world. Obviously, not want to pick on him or claim that he's well worth following. Capital Wars on Substack. He's amazing. But one thing I've noticed is that, yeah, you can always say once you have a predictive model, you can always say, well, what's the average move based on these two things that predict one another? In other words, you can always say, well, when Japanese M2 moves up 1%, how much does Bitcoin move in percentage terms on average? There's gonna be a number. I think I have the number. I've been able to verify Michael Howell's numbers. I think it's about 5x. So 1% movement in the price of Japanese M2, 5% movement in the price of Bitcoin on average. That's all over the place. In reality, it's anywhere between 0.5% and 15%. In other words, it's completely irrelevant. It reminds me of Fibonacci ratios. There's so many. Of course, it's going to land on one of those. And if it doesn't land on one of those Fibonacci ratios, it's going to land right in the middle of two. What are the odds? Well, the odds are actually pretty high. If you keep adding levels, Bitcoin will hit one of those, or any market. It'll hit one of those. However, can you predict which one it will hit? I haven't been able to. I've not really seen anybody who can do that consistently, saying, hey, it's always 61.8, or it's always 50%, or it's always 75%, or it's either this or the other. Usually I've seen them have 10 different levels. And yeah, of course it's gonna hit one. This again is maybe controversial, but and I know some really, really good traders who use Fib day in, day out, and they're very successful. So I'm not saying it doesn't work. Saying it's not for me. It's not consistent. I like consistency. Anyways, so question. Are you sure there's no way the bond market was pricing in the Iran war a year ahead? It's not that far-fetched. Globalists have had long-range plans spanning huge amounts of time for their chess games. Could be. I don't know. Actually, that's a very good question. So, because I've always wondered, I've always wondered, why do these correlations exist? Because they don't make sense. The conventional explanation is that, yeah, you have the interest rate. And by the way, I can make those, I can weave those conventional explanations too. Look at these three models. Let's get rid of some of these drawings. There we go. And let's get rid of Bitcoin for a while. We don't need Bitcoin for this. Let's take a look at macro. What are we looking at here? What are these three indicators? So notice how closely correlated they are to one another. And what are these indicators? So first you have interest rates. This is the 10-year treasury. That's a rate. That's the interest rate inverted. So think of the 10-year, the price of the 10-year treasury as inverted 10-year rate. So that's what this is. So you notice that this is the one that predicts the other two. So this one predicts interest rates. This one is T-bill supply. So how can we explain this from an economic perspective? We can say that the lower the interest rate goes, the more debt the government issues. Does that make sense? That makes perfect sense. So interest rates go down. A few months later, the government is selling more debt because it's cheaper now. That makes a lot of sense. And then what happens? Well, once they start issuing more debt, the dollar gets debased, and the third one moves. And then when we add Bitcoin, this makes perfect sense. I actually like this explanation quite a bit. It makes a lot of sense to me. So then the dollar gets debased because the government is issuing more debt. And when the dollar gets debased, risk assets like Bitcoin react, and they move. So if the dollar is debased, Bitcoin moves higher. If the dollar goes up, Bitcoin moves lower. It makes perfect sense. In fact, I do think there's something to this. The problem is, I've seen these macro indicators make predictions that there's no way that was being priced in. So Perry, to your question, I don't know. Could be, but I don't know. I don't know that. I don't think that's what it is. Or maybe it is, because I mean, again, this explanation is pretty good. You can even see here, I haven't updated this T-bill chart yet. I don't know if you can use API calls within TradingView. I think maybe you can, but notice that it doesn't highlight this May top. It says Bitcoin should just grow or rally into, I guess, July. More on that in a moment. I do want to discuss that, but not time yet. But it is kind of following this bond market. So T-bill supply, even though we only have monthly data for it, it does seem to be following the interest rates. So the black line. The explanation makes a ton of sense, but like I said, I've seen these macro indicators predict things that they shouldn't be able to predict, such as the fact that the bond market, about 10 months ahead of time, said that the dollar was going to have a rally between, actually, let's get rid of the offsets. Get rid of the offset. So the bond market, and this is 56, you need to do 44. There we go. Okay. So now we're forgetting Bitcoin for a moment, and we're forgetting T-bill supply. So notice that the bond markets 10 months ahead of time said around February, the dollar will have a rally. And it will have a rally that will stop in March 30th. That just so happens to sort of line up with the Iran war. So in a sense, the bond market 10 months ahead of time predicted a dollar rally that was all about, it had everything to do with conflict in the Middle East, but it did it 10 months ahead of time. That doesn't make any sense, in my opinion. That does not make any sense. So we go from, yeah, this conventional explanation of rates moving first, and then the debt supply, then the price of the dollar. That makes sense. But then when you look at the moves that are actually predicted by the bond market, for instance, it make no sense. I mean, how can anybody know 10 months ago that the war will break out, and that's when the dollar would strengthen? Or maybe another explanation is, well, and this is, I think, where Raoul Pal, the likes of Raoul Pal, land usually on this, is actually that's just noise. It's not really the price of the dollar. It's not the war. The war is not why the dollar is moving higher. The dollar is moving higher because rates moved higher 10 months ago. Has nothing to do with what you're seeing. What you think you're seeing is not what you're seeing. It's actually something else entirely. It's not what's causing it. But I don't accept that explanation either. Why? Because you can look at oil and how oil has predicted. Sorry, this is from the issue this week at Weiss. You can see how, yeah, sure, the dollar. If I overlay the dollar index here, you can see it move 1-to-1 with oil. So you cannot say the price of oil in the Middle Eastern conflict are having nothing to do with the price of the dollar. That's not true. It's not just the macro. It's something else. I mean, I actually think this has to do with cycles, which speaks to the fact, why is Bitcoin's price not following liquidity even loosely? Normally it follows it loosely. Why is it not doing that? Well, keep in mind that Bitcoin cycles are bearish, and they turn bearish according to my work. There we go. We draw this black line. I've shown this black line before. I highlighted it at the time when I said the 4-year cycle has stopped. And this is a late indicators, not particularly early, but get rid of this. So here on this date, this exact date, on November 14th, Friday, November 14th, 2025, Bitcoin crosses the 320-day cycle low VTL. At that point, the 4-year cycle is officially bearish. We are in crypto winter. During crypto winter, we know that rallies are weak. They're muted, they're weak. And so when you look at it from that cycle perspective, the fact that Bitcoin is not following the, how do I say this? The fact that Bitcoin is lagging behind central bank liquidity, it makes perfect sense when you look at it from a pure cycle lens. Why does it make sense? Because rallies during crypto winter, during the down phase of a 4-year cycle, they're always weak. You never get a good rally during crypto winter. Never. By the time you get a good rally, crypto winter is over. You're not going to find this unless you go back to like 2014. But from 2014 to the present, you do not find, there's not that many crypto winter periods. There's only 3. But you don't find any strong rallies until the cycle ends. By the time you have a strong rally, the cycle is bullish again. Let me show you 2022. So in 2020, this is crypto winter 2022. Too many lines, you guys, too many lines. All right, so let me draw the same black trend line, the 320-day cycle low VTL. If you don't know what that means, please watch the lessons on YouTube. All right, so boom, there we go. This is the 320-day cycle low VTL. So what does the pure cycle picture say? And by the way, the macro was definitely bearish in 22, so it was easier for people like me to make sense of the bearish price action. It was easier because the macro was bad. Now the macro is good, but prices are still horrible. So how can we explain that? Well, maybe the explanation has to do with cycles, not really macro. Macro continues to work phenomenally well, so a timing indicator doesn't really tell us what to expect in terms of price action. But cycles do. So notice that from this point, let's say that the crossover, because I've said many times before, when prices are testing a VTL, they're going to cross. And so they started testing these VTL here on January 9th. So from January through, you can fast forward about 2 months, prices are in crypto winter. So we have no rallies on liquidity. So again, for us macro people, 2022 was easy. Macro was horrible. Now the macro is good. Prices are horrible. It's much more confusing. That being said, this is all of crypto winter. So crypto is just horrible during this entire period, 2022. There are no good rallies. So we have these rally here. This is January through April, I think. Yeah, early April. Horrible rally. You have another rally here, June through August. Pathetic, horrible rally. We're in crypto winter. Bitcoin actually doesn't. That's what it does. These are crypto winter rallies. They're dead cat bounces. These are bear traps, not something you can buy. There's only one. Here's a rally. Here's a good rally in crypto winter. Right here. This ended crypto winter. This is technically not crypto winter. This is a 4-year cycle low. It took place in November. So this January 23 rally, we're not in crypto winter anymore. So you can see, as long as we are in the declining phase of the 4-year cycle, crypto rallies are weak. They're always weak. And apparently, this is news to me too, but apparently crypto rallies are weak during crypto winter, even if the macro is good. So even if the macro is good, the rallies suck until it ends. So which one of these rallies am I going to get excited to buy? When the cycle picture changes, when cycles say, hey, we're out of crypto winter, we're not in crypto winter anymore. When did my own timing model say we were out of crypto winter? And Alex, I think if you're still here, my friend, you remember this. It was in early January, this breakout right here. We started sending buy alerts at Wise without my consent, and I got pissed. And I said, no, don't do that. Because Martin Wise, the founder, was saying, and Alex, you were saying the same thing, but the model has shifted bullish, right? I was just being cautious. And it was being too cautious. And we bought this rally. And this ended crypto winter. My model went bullish, not neutral like we're now. It went bullish right here as of this breakout. So on this date, on January 12th, that's when it went bullish. Now, why am I saying all this? Well, this is a long rant. As you know, this is how I like to do AMAs. But now we're going neutral. We're going neutral. That means the worst of the sell-off is already over. When did we go neutral in 2022? Right here. Changing this and this. There we go. This is when we went neutral. Make this orange. This is what neutral means. Just so you know, it doesn't mean it's not a buy opportunity. You definitely don't buy those. During rallies, you don't sell those either. It means pause. So that's what neutral means. That's why I have it there. It's like a sandwich between bull and bear. Most people say either bullish or bearish. There's actually a third. Zero. Nothing. Sideways. This is neutral in 2022. Prices go neutral. FTX collapses, but prices were neutral. And it just works. I don't know why. This is not my word. This is Hearst. When Hearst cycles go neutral, market's neutral. So you can buy these crashes, and they're short-lived. They're very short-lived. Same thing happened in 2018. There was a bit of a stronger crash in 2018, but kind of the same thing. Bitcoin goes neutral. I'll spare you details. It went neutral here. So notice it goes neutral. This is 2018. It goes neutral. Hide this. It goes neutral on July 18th, July 24, 2018. What follows that? What follows that is what you expect during neutral. This. Then you have this sell-off. In this case, we made new lows. Easier to predict this one if you were around at the time. This is when the hash war started. So it caused the price of Bitcoin to crash. But from a timing perspective, this is very brief. It only lasts about a month. And then that's it. That's the end. So this one had prices did nothing for months. We're not going to see that this time around. But this is what neutral means. It means the worst part of the crash is done. The worst part of the crash was all of this. This was the worst part of crypto winter 2018. And back in 2015, you can see the same thing. I actually have the line drawn here. This is what neutral means. It goes neutral. In this case, we have some follow through. I'm expecting this time around, by the way. It's just cross to neutral. We keep going higher for a little while. That's simply because of the timing tools. So and the timing of that neutral cross. We go to neutral. And then what do prices do? Well, they do nothing. They do nothing for a while. And around August, we retest the lows. So this low retested in August. That's it. That's what I mean by retest. It doesn't have to exceed it. You can see in 2018, we do exceed it. We do go lower. If and when the current cycle turns down and we head back into the 60s, you can tell whether or not prices will rush below based on what's happening. back in 2018, the only time in these three bear markets when after neutral we actually have a bit more of a downtrend. It's a hash wars. This was echoes from the 2018, from the 2017 split between Bitcoin and Bitcoin Cash. And November, this time period, November 2018, you have the likes of Roger Ver and some huge Chinese miners trying to take over the Bitcoin network. It was like the good old times in crypto. And that caused the price to crash. It caused a lot of people to liquidate. Roger Ver, I think in particular, was selling a lot of Bitcoin to try and pump up the price of Bitcoin Cash. It was all this shenanigans going on. It was easier to predict. It was just as easy to say this will probably not last very long, just like the FTX crash. And if you look at the cycle picture, you can see why, because you're already neutral. You went bearish, you had your neutral phase. Usually toward the end of crypto winter, you have another down leg. That's the one you buy. That's the end. That's usually it has usually followed that pattern loosely. It doesn't mean, you know, cannot go down to 50K, cannot go down to 45. No, it can. Depends on the catalyst. There's usually something that I don't remember what happened in 2015 because I was not trading at the time. So I don't know what happened. I don't know what
Um,
caused this sell-off.
yes, 2015, we had this long winter, and that time it was actually about it became more about like blockchain will stay, but everything else will die. I mean, I don't remember exactly,
Uh,
but I was around there.
uh-huh.
But it was, I mean, yeah, it was still magical money used for that guy who was in prison. Yes.
Yeah,
Yeah,
that,
so
yeah,
Mount
yeah,
Gox, that happened in like 2013, 2014. Yeah.
yeah.
So, and then that guy was in prison. So, yeah. And then the other guy, I think Charlie Shrum, he was based here in New York, even though he was in jail, like the early people. So it was like really bad. So if you talk with anyone like you're in crypto, it was not a good time. I mean, people will give you their eyes like you're doing some shady stuff. Yeah. And
Yeah.
then it was the smarter people who'll say technology will stay, price may not go anywhere. It was a
Hey,
long.
that narrative was strong in 17 and 16 too. Even 19 people were saying that. Oh, it's a private blockchain. Public blockchains will never do anything. It's private blockchain. So I guess the narrative didn't go away.
Yeah.
Um, yeah. But the bottom line is this. There's usually a scare. So I'm a pattern guy. I like to look for patterns. Even if the pattern breaks, it's useful to find a pattern. So crypto winter always breaks down as big crash, usually no news at like nothing major happening. The first leg down is the worst, and there's no news. It's like prices just crash because they want to crash. That's the first leg down. Not always. I would say that's loosely what happens because I think 2014 is to a point, Sandeep. This is Mt. Gox collapse, but prices started crashing before the Mt. Gox. Again, was not around at the time, but my understanding is this got really bad later in 2014, not early 2014, but early 2014, we already have prices crashing. We're crashing by 70%. So the pattern is roughly like this. You have the crash, then cyclically speaking, you go into a neutral phase. After that neutral, and the neutral phase lasts the longest. It's months of neutral, months of boring. Anybody who likes statistics, you will know markets most of the time do nothing. That's why selling options work because oftentimes option prices are inflated. Why? Because they're overstating volatility. That's why you can make money selling options. I used to run a fund that would only sell options on the stock market. It works really well until it doesn't. I was actually doing that in 2017. That fixed at all-time lows. It was very tough. It was very difficult. But regardless, markets spend most of their time doing nothing. And so this is true in crypto winter too. You have this first leg down, always the worst. It's always the worst. I think we're past that, is what I'm trying to say. Then we have the neutral phase. The neutral phase is what you're seeing in 15. Is I like 15 because it's like classic, horrible bear market, classic neutral phase, scare at the end. And the last phase, we're not there yet. I think we're going to be there in July potentially, which I will admit it's a little early to expect that in July. But I think based on what I'm seeing, it could be in July. Um, if not, it's going to be in October. And that's what you should expect based on pure cycles. So you have worth the bad crash, people's hairs are on fire. Then you have the neutral phase. Then after the neutral phase, something scares people. And there's another leg down, but it's usually brief and it's usually tied to something specific. And what happens then is that there's a lot of apathy in the market. People have already walked away. After a crash and months of doing nothing, nobody's really in crypto anymore. And so you can't crash. This is the pattern from 22. This was very clear in 2022. It was so clear because you have the FTX collapse. The FTX collapse comes after a series of bankruptcies in crypto and prices being down 80%. But not only that, at this point, by November of 2022, it's like it's not even clear why FTX, which is a Ponzi scheme, crashing is bad for crypto. Like it's not even clear. Like, why is that bad for Bitcoin? What does Bitcoin have to do with SBF gambling with other people's money? Nothing. And so prices kind of reflect that. And if you were around at the time, I remember this very well because it's exhausting. After months of nothing, it's exhausting to see Bitcoin crash from 21 to 16 in 2 days. It is soul crushing. I get it. I've been there. I was accumulating through this entire period, and to see this crash, I didn't sell, but I was like, really? We're going to 16? Really? Over this? But here's what happened, which is very telling. You have FTX crashing. We were actually holding the Y Summit at the time, so I couldn't get all of my money out of FTX because we had a cocktail reception thing, and I had money stuck in there because I was like, I can't do this now. I'm gonna go down to the reception. I'll come back and do it later. When I came back, FTX was shut down. That was my personal FTX experience. Not a lot of money, but here's what happened on Tuesday. I think this was Tuesday. Yeah, no, it was Thursday. Inflation comes out. Nothing to do with FTX. Inflation comes out softer than expected. Bitcoin rallies. Bitcoin rallies after crashing by, let's see, 14% the previous day. Bitcoin rallies by about 11% the next day. And that's it. That was it. That was the end of crypto winter. It was very telling because all of these big lows always made the same way. Big crash, big rally. I think I said this in February at the time because we held the AMA exactly on the date of the low. It was not clear that it was a low, but Bitcoin had been crashing, 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 crashing. Then it went up 12% on a single day. That's it. That's your low. That's how it usually ends. And so we're not there yet. It's probably
I,
going to do what Japan. And look at this. Just before you cut me off, Sandeep, and I'll shut up after this.
no, 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 please go
Notice,
ahead.
notice this. What does Japanese and 2, which has been able to predict prices better than the other macro tools, what is it predicting? But it's predicting, this is why I believe Japanese into quite a bit here. It is predicting what normally happens and what you would normally expect if you had nothing to do, if you did not know anything about macro. Because it's predicting a rally. We can discuss how high prices go. But no doubt, they're showing a rally, all the macro tools, they're showing a rally into May, and then they're showing a retest. They're showing prices going down again. So they're showing what I just described. The big crash, then the neutral phase, then another sell-off, and that's the end. That's what macro is showing. So that's why I believe Japanese here, M2. It makes a lot of sense. This is usually what happens in crypto winter. You have big crash, months of sideways, then another, let's call it mini crash. A lot of apathy is what you see at the time. You see panic from the diehards, the people who never leave the space like me. We're just done. I mean, you feel exhausted at that time. You just can't take it anymore. That usually means it's over because everybody else is feeling the same way. We're exhausted, and no one's gonna sell. Like, who's gonna sell after? Let's say that low is not in July. Let's say it's in, I don't know, October. And by October, if you haven't sold already, you're not going to. And so that's how you can tell it's gonna be a bottom. But we'll see. I think this time is gonna be different. I think already it is different. The fact that we're entering the neutral phase, Bitcoin usually is down 70% by the time it goes into the neutral phase. And now it didn't go down. It only went down by 50%. So already it looks like a weaker bear market than usual. And so if that continues, then I do believe this is roughly where the low is. 60K, maybe 55. But if it goes to 55, it stays there for a week tops. Maybe not even have the Perry, you know this one, the 3-day rule. where it breaks the low, but for less than 3 days. I would expect to see that if it goes below 60K at this point, right now, with the information we have. If Bitcoin goes below 60K, I would bet that it doesn't close for 3 consecutive sessions below that level. All right, let's
Yeah.
move on
Hey,
here.
Juan, you just kind
Yeah,
of like brought that up, something that we were discussing, I think, yesterday.
yeah,
Uh, and you just made the statement too, like this time it's kind of a little different and we're already seeing the neutral phase.
yeah,
And this is what I am seeing with institution money,
yeah,
right?
yeah.
Strategy, every week they're buying like $1 billion worth of, like this week they bought billion, like not every week, but basically their buying power is huge,
Yeah.
right? Same thing with Morgan Stanley. They launching ETF, 1 to like 6% allocation into digital assets, having 16,000 advisors. So that's literally like hundreds of billions of dollars in getting invested into crypto. And actually, this week it's going to be Goldman Sachs also. They're also
Oh,
launching
really?
their ETF. Yeah.
Oh,
So
interesting.
here, like this is something that I'm seeing very different. Means, yeah, we can talk about these Bitcoin cycle in the past, but that
Hmm.
was all retail driven. This cycle, I have not seen retail at all. Um, and at this floor, basically in 60s, these big institutions are buying big time. Um, and
That's a
that's
good
where,
price.
yeah, and that's where, and I think like as per my resources, it's Clarity Act would pass in, let's say, next 45 days. Let's put it that way. It's very close to getting passed. That's how it looks like.
Okay.
So considering like all of that, um, I mean, if we say on Monday, right, the Bitcoin was trading at 70. On Saturday, the news came from war when our P stock fell off. And then, Bitcoin dropped from 74 to 70. And then Monday, if you see that last week, ETF flows was almost 1 billion in BTC, like, and that's highest so far in this year, weekly inflows. Um, and then, of course, Strategy, they bought $1 billion worth of Bitcoin. So we can say that when that kind of news came, price just in one day, in 24 hours or so, moved from 70 to like 76, right? And now
Yeah.
it's kind of dancing around like 73.5 to like, that range,
Hmm.
which is a retracement. So, like, how do we see that when we are seeing this big money kind of coming in and they're setting the floor and every like dip gets bought, I would say. Um, and then of course we have the liquidity cycle. Yeah, I mean how it's gonna change our cycle projections.
Well, I mean, I think I've been trying to answer that. So
Mhm.
the reason I switched to this chart is the other difference, other than the institutional buying and the MicroStrategy and all of those stuff. There's another one. I don't know if you pointed out, but no bankruptcies, like no major
Yeah.
bankruptcies. Like in the last cycle, people went bankrupt and they were going crazy. Not this time. And I was at this cruise conference about a month ago. There was a Bitcoin talk there, and one of the guys was saying, "Oh, we haven't even seen the bankruptcies yet." He was quite bearish. We haven't even seen the bankruptcies yet. And I'm like, yeah, I don't think we are. Like we would have seen them already. These guys are reckless. They get liquidated early. They don't get liquidated toward the end, but unless you're FTX. But let's like I don't think we're gonna see those bankruptcies because I think that the space is maturing. And I think expecting to your point, Sandeep, I mean, it was a retail driven phenomenon. These bankruptcies were from companies offering products to retail traders and retail investors, whereas now it's more institutional, and these guys are not that stupid to put their money on Celsius or whatever, with no audits and no accountability whatsoever. So the market is maturing. I would not expect every crypto bear market to come with a flurry of bankruptcies. Everybody goes bankrupt because they lever too much. It's like, no, at one point we learn. We don't do it again. Does anybody trust, would anybody trust a Celsius style platform ever again? Probably not. Would you have your money on a crypto exchange that has no proof of reserves? I don't put my money, no proof of reserves when it has become the industry standard. It means they're probably going to steal your money. That's what it probably means. Why are you not following this standard? Everybody else is doing it. They have these hash trees to prove how much they own. You have third-party um, on-chain trackers showing you, labeling their wallets, showing you their holdings. There's a lot more accountability in the space now. It matures. If you believe in free markets, this is what happens. Survival of the fittest, and things get better over time. And so you cannot extrapolate the past into the future forever. So that's one thing. No bankruptcies. Of course, the market is more mature. It's dominated by institutions. And I think we're seeing it. We're seeing it in two ways. The sell-offs are not as bad. These guys tend to buy the lows. They also tend to sell rallies, which means the rallies are not as strong. I think we're seeing this institutional footprint all throughout this 4-year cycle. We are seeing it. We're seeing it right now. The other thing is the macro has never been this bullish, like liquidity, interest rates, just that side of the monetary plumbing has never been this bullish during crypto winter. It has always been bearish to the point where I, among others, have held a belief that you cannot really have a crypto bear market if if liquidity is going up. That was my statement. Like you cannot have that because the thing that causes the bear market is a vacuum in liquidity. We do not have a vacuum in liquidity now, but we still have the bear market. We still do. So the way where I come on this, where I land on this is it's gonna be a not so bad bear market. I think we're already seeing proof of that, but you can
Mm.
clearly see the cycle dominate the price action still. And cycles are driven by psychology, nothing else. And people started selling Bitcoin for no reason because this was the no reason sell off. Other than up until now, we had this liquidity, especially in the yen, we had this liquidity, sharp liquidity sell off. So I was among the ones I saw this sell off coming because I could see it reflected in liquidity, and it was pretty bad. We could see that it was bad, and then why did it not recover? Because we saw the sell off reflected by liquidity, but we didn't see the recovery reflected by liquidity. Why did that happen? Well, I don't know. I don't have an answer. My answer is once you do enough damage to a chart, once prices go down enough, people switch to bearish mode and they go, oh, we're in a bear market. I'm going to sell every rally. I'm going to sell on strength. And we're kind of seeing that. I think we're seeing it right now where people sell because it went to 76. Because at this conference, this guy that was pretty bearish, he was like, I'm just going to sell. If it goes to 70, 75, I'm just going to short it. I'm like, okay, this becomes a bit of a self-fulfilling prophecy. And I think cycles are great at that because they distill everything, not only the macro stuff, but also how people feel. And
Mm.
around late January, people just turned bearish. Everybody was looking at their 200-week um, moving average and all these things. And we're like, well, we crossed the 100. Now we're going to the 200. That kind of becomes self-fulfilling. And it takes a while to repair that damage. I mean, that's kind of where I land on this. For me, it's
No, I
easy.
hear you.
Yeah,
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 because right now that's what I'm seeing with technicals. Means if you look at 4 hours technical chart, I mean it's just showing me that's it, like 76, and there are people literally drawing, lines to 52K from here, like straight from here.
yeah. I don't think so. I want to be on the record. I am actually because I'm recording this. 52K might happen, but not from this high.
Yeah.
Not from this high. I don't think so. I just don't think so because then we're actually violating these macro indicators that have
Yeah.
worked. They have worked. They did. They pointed to the February low. There, this thing is right within 6 days. So within a week. So it's like, is it not working? No, it is working. It is definitely working. It's just kind of doing what the footprint says it can do, which is okay, you're gonna have a low between and this day, you're gonna have high, you're gonna have your high on this date, and prices are not gonna move between those 2 dates. It's just gonna go sideways. That is kind of within the realm of possibility. So as frustrated as I was that my macro wasn't working, I have to say no, it was. It was. And but yeah, crypto winter. Anyways, let me get back to these questions. So Perry's saying, I think last month you said that the declination component of your astro model is more important than the orbital, sidereal. Correct. Is that correct? It was correct last time, Perry. It's no longer correct. If so, are you still finding that true now and presumably moving forward? No, actually, no. Declinations are still important, but declinations were the first. round of these new planetary models. And the reason is quite simple, Perry. Declinations, if you've seen a planetary declination, it looks like a sine wave. So a declination is basically a planet moves up and down relative to the equatorial plane of the Earth. That's geocentric declination. You can also have heliocentric declination, which is the sun itself has an equatorial plane, and planets will move up and down that plane. Okay, so that's declination. So why do I like declination for predicting price action? That actually goes back to 2012. In 2012, when I was studying Hearst, I was doing most of my studying at the time. Um, I haven't really read books on trading since. I've read a few, but not as much as back in 2012. It was like I was digesting everything I could get my hands on. This is when I was studying Hearst. I was also studying from Ray Merriman, who didn't have a course at the time, but I read all his books, and I was trying to incorporate all of this into my work. I could never quite fit Astro into my work, but the one thing I noticed is declinations. Specifically, I was trading mostly the stock market. And I noticed that the declination of Mercury, which is this beautiful sine wave that moves up and down, had remarkable predictive power over the price of the S&P 500, so the U.S. stock market. I noticed that. Now it was a loose correlation. It didn't work all the time. If it had worked consistently and every single time, I would have used it as a tool. But I noticed that it was sometimes it would work, sometimes it wouldn't work. Sometimes the midpoint of your declination, the midpoint. So it was between the high and the low in declination. The midpoint acted as a reversal. Actually, that is now in my new models. That is a rate of change. The midpoint of a declination move is when the planet is moving the fastest. These models that I have now track the rate of change. So the first derivative of that declination. So I have those midpoints too. But suffice to say, I didn't have the tools to really reverse engineer, it's like figure out the pattern from this random movement, seemingly random movement, into a proper model. I didn't have the tools for that because, yeah, I didn't know how to do it, honestly. I mean, I needed to know more programming than I did know. I had to read up more on statistical analysis than I cared to do at the time. Is really AI that changed it for me because with AI you have like a super assistant that can do anything you ask it to do. You have to guide its hand always. When I asked the AI, how would you take declinations and predict the price of Bitcoin, it came up with a bunch of nonsense ideas. So then I said, no. This is the equation we're trying to approximate. What are the tools? And then he said, well, if you want to do that, these will be the tools. So it's a great assistant, very smart. It knows everything. Oh, not everything, but it knows everything humans know. And so it knows of all the methods and all the papers. It said, are there any papers that have been written on this? What are those papers? Can I read those papers? So I got a sense. I used AI to study how to do this. And once I understood how to do this, I used the AI to create the model. And so why did I do declinations first? Because I observed back in 2012 that declinations, especially the declination of Venus too, so it was Venus and Mercury, I noticed that there was something to it. But there was not much. And back then I was studying Hearst mostly, and Hearst is awesome. Hearst is simple. If you look at how lightweight the Hearst model is versus the Astro models, it's shocking. It's like an Astro model will take 20 minutes to run on Bitcoin, for instance, whereas I can figure out cycles in 50 seconds. So in 50 seconds, I have all the cycles, all the indicators, the trend, everything, even pivot points where you should buy and sell, everything, 60 seconds, within 60 seconds, let's just say. Whereas the Astro model takes 20 minutes and it gives you potentials and possibilities. So it's a lot more complex. It's a lot more computation. Um, but anyway,
Excuse
going
me,
back to your
Juan.
question, yeah.
Juan, your mic has dropped off. The volume is. We're having a hard time hearing you.
Oh, really?
Yeah.
Oh no, that is not good. Is that true for all of you guys, Sandeep?
Yes.
Oh, why is that happening? Oh, let me reset it. Yeah, because you're probably saying that, but I didn't hear you. Hang on. Let me just unplug them, plug them back in. Oh, where are they? I wonder why that is. Let me do a test. Uh, Blah, 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 blah. 1, 2, 3. Yeah, it's very low. Right. Here's what I'm going to do.
And reconnect. Is it better?
Oh, much better. Yeah.
Oh, okay. Yeah, I can hear myself too. Yeah. Not recommend the Samsung earbuds. I don't to fail too much. AirPods are better. Anyways, all right. So is it good? Can I continue?
Yep, please.
All right, awesome. So where was I? So declinations. So the story is this. I figured there's actually, if you look at any astrologer, they do more work on the orbits, the sidereal movement, than the declination. Most people ignore declinations. But the problem is the declination is just a circular motion. It's like it moves in a circle, 360 degrees. How do you turn it into a sine wave? Well, actually, you could just do sine on the, this is trigonometry. So you just do sine of that angle, and then you have to subtract blah, 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 because you have to turn it into gradients, whatever, blah, blah, blah. That is standard trigonometry shit. But you can actually take that circular motion and turn it into sine wave motion. You do that, and now you have something that is much more powerful than declinations, which is you can use the actual orbit as a sine wave and its first derivative, the speed of that movement. And now you have, instead of 9 declinations, you have 450 different combinations to try. And this was the breakthrough since my last presentation. So I already had that done. I had already created something I call the zodiacal model, which is that orbit. But it wasn't really, it was missing a lot of stuff. And anybody who's done work on statistics, if you throw a lot of variables at something, you're going to be able to predict what happened, but you're not going to be able to predict what's going to happen. In other words, they overfit. All of these methods, OLS, lasso, ridge, all of these methods overfit if you feed it a lot of variables. And what happens with the planets in the solar system, plus all of their combinations, plus declinations, plus the midpoints, plus all of this stuff, is you're going to confuse the model. You're going to give it 2,000 things. You're going to say, with these 2,000 things, I want you to predict, I want you to model the price of Bitcoin. It will model the price of Bitcoin just as you ask it to do. These methods will do that. But then you're not going to be able to predict anything. That's classic overfitting. So then I've spent the last month, roughly speaking, trying to fine tune, trying ways to filter out noise from signal, then taking that signal and combining it into a final model. And then the last thing I added was natal charts. So I actually reset all cycles to 0 at a certain date. That's what I'm doing with Bitcoin, and it works extremely well. So yeah, that's what I've been doing. And so now declinations are actually a second tier model now. I rarely use them. When they work, and I use them. But mostly I use the orbits now and the natal model. Natal model just simply means that let's say on the date of Bitcoin's first block, you start the clock. Then for every orbit and every cycle, you just say start here, start on this date. Whereas the non-natal model, the zodiacal model, just takes whatever the position of the planet is, that's what it is. So it's 0 at 0 degrees Aries, and then it goes through the entire circle back to 0 degrees Aries. So that's the only difference between the two. Most of the time, the zodiacal model, the one that does not use a natal date, most of the time that works best. Some of the models that I have do not have a natal model. You don't actually need it. But it's good when you have it. All right, so comments since the recent AMA have had so many explanations on macro liquidity concepts, good stuff. It might be nice since this AMA to also get back to showing charts with market cycle drawings like your latest VTLs and FLDs, like you recently talked about a little in Discord, 80 days, 240 days, 60 months, 48 months. So that's what I'm trying to do here with these VTLs. I don't know if that answers your question, Perry, or not. I do want to get back to the cycle stuff. Usually, and I apologize for this, but I usually talk about the stuff that I'm working on at that moment. So, I'm not doing any work on Hearst or VTLs. I mean, that stuff works. I've used it for 15 years and it works extremely well. You can trade on that. You don't need any of this forecasting stuff, any of this macro stuff. You can just trade on cycles. VTLs. You can just trade on VTLs, and that's good enough. But I do want to predict because I do think that there's something to it. So, yeah, I don't know if that answers your question. I want to move before I go into oil, metals, S&P. I want to keep doing whatever that's crypto. All right, Barry. So just remind me if I scroll down through these questions. Remind me to get back to the. I at least want to talk about the stock market because the stock market is crazy, guys. And that's going to be a nice segue into showing you what I have with these Astro models, which I'm not really ready to comment too much on this, but I'm gonna give you all access to that when I think it's somewhat ready. I'm gonna put it online. You're gonna be able to access it, but I'll discuss that hopefully in a couple of months when it's more presentable than it is now. But all of you here will have access to those, and I want your feedback. So if you're gonna, you know, use these tools, please submit your feedback because I want this to be a product that people use at some point. It's a big thing I'm building and I'm very excited. I think it's amazing. I think the last time I showed it, I didn't do a good job of conveying how good it is, how strong it is. But hopefully, over time, you're gonna see how powerful these models are. Even though they have inversions and a high can be a low, or that stuff. Anybody who does cycles knows this. I learned a lot from one of the best forecasters in the world, I think, Martin Armstrong. I've come to know him. Wouldn't call him a friend, but a close acquaintance. He's very good friends with some of my best friends. I know the man. I know his models do not predict highs or lows. Everything he predicts is a turning point. If he says, "Hey, my model is showing May 9," you don't know if it's a high or low. And he's always said you can't do that with cycles. Well, it turns out my models are not only have solid statistics behind them, they actually do predict highs and lows. They can invert, but not often. It's not often that they do that. And when they do, it's obvious. Anyway, so I'll move on to ETH. A stronger play than BTC in 2026. Timing, also alts, others likely best time to sell anything still holding around that time as BTC in May. So Natasha, to answer that question briefly, I'm going to get into the alts, of course. But the reason I talk about Bitcoin is alts will just be a derivative play on Bitcoin. It's the same trade. So just again, this is not trading advice, but if you think you can build a portfolio of crypto by diversifying and buying a bunch of alts, not just Bitcoin, you're deluding yourself. It's the same trade. The same timing that applies to Bitcoin applies to all the alts. Now, of course, you could play the next hottest, latest crypto asset like Solana was in the last cycle. And sure, that's a high beta play on Bitcoin, meaning when the bull market is going, you're going to make more money holding Solana than you're going to make holding Bitcoin. I'm not saying there's no merit to this. But remember, I'm a market timer. I do timing. So what's the timing for Solana stop? May 9. What is Ethereum expected to end its rally and head lower? May 9. Why? Because they're all aligned. Everything that was shared here up until now applies to the alts. But let's look at the alts. And I personally don't even look at them most of the time. I just don't care. They're going to do whatever Bitcoin is doing. Personally, right now, I hold ETH and Solana, mostly staking Solana. But I do hold ETH because I love ETH. So Perry's saying, so you mean I can't retire on the worst degenerate meme coin? No, you cannot. During the crypto bull run. So let me put it this way. If I was to trade, if I forced myself to trade during crypto winter, as I have now, I would not bother with anything that isn't Bitcoin simply because the alts tend to be far more bearish during crypto winter than Bitcoin. This is typical. So the alts tend to underperform on the way down and outperform on the way up. So during crypto winter, if you're trying to trade crypto asset, I don't mean day trading. I don't mean position trading where you hold for a week. I mean, you're going to hold a position for a few months. Like I have. You buy in February, you sell in May. That type of trade in crypto winter, stick to Bitcoin because the alts are not gonna, they're just gonna, underperformed to various degrees. And so here you have Ethereum's what is there to say? The one thing I would note, and this is why altcoin analysis is sometimes useful, the 80-day high VTL, this is what I use to delineate bearish from neutral phases in crypto winter. And this VTL was crossed over on Ethereum last week. So it was crossed, Ethereum crossed above it on April 10th. So Friday of last week. And that was a prelude to Bitcoin doing the same thing on April 13th. And so over this weekend where the peace talks were being held and there was a fiasco and it was a disaster and it's a conspiracy, they're not real, blah, 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 whatever. Actually, what the price action was saying, if you were looking outside of Bitcoin, was useful. It was quite useful because this VTL, this again delineates bearish from neutral trends. So out above this trend line, the market is neutral. Below this trend line, the market is bearish. And Ethereum was already showing signs of crossing this trend line as early as April 7. By April 10, we're crossing above. So Ethereum switched to neutral before Bitcoin. 3 days before, doesn't sound like much until you remember that was when the peace talks were going to be held. So that was prices telling you, hey, this is probably going to be fine. So we're not going to crash, which was my concern. Are we going to crash based on these talks? Well, if you're looking at Ethereum here, not really, probably not, because it's already switching to neutral. I've seen this before, where an altcoin, a leading altcoin, I'm not going to take cues from Pepe. I'm not going to take cues from Pendle, but I'm going to take cues from ETH, maybe Link, some of these leading altcoins. Like some of them can move ahead of the big one, ahead of Bitcoin. So crypto winter, Perry says BTC goes down 50 to 70%, whereas alts go down 80 to 99%. That's exactly right. So they just exaggerate what Bitcoin does, but they do not deviate in terms of timing. And since I focus most of my time or efforts on timing, I don't bother with the altcoins. But like I said, sometimes it can act as a good leading indicator. So what is the outlook for ETH? Same as Bitcoin. A high on May 9, everything made a low in the same day. I stake a lot of Solana, and I like this strategy quite a bit. And so that means I watch the price of Solana because I've been mining Solana for months, and I haven't sold a single one because I find that prices are extremely low, and I'm not selling my Solana below $100. I'm just not going to do it. I would consider it. I would entertain divesting out of some of my Solana at $90, but below 100 or below 90 is ridiculous. It's like you can't even start the conversation. And same thing, like you can notice here that Solana also went neutral. I don't like these sideways crossovers so much, and I especially don't like when they cross the VTL at the lows. Like this is not inspiring to me. And so Solana has been quite weak. Other alts that I track, you know about this one, CRV, mostly because again I stake it. Extremely weak. It looks extremely overdone. Like it looks like it's done. This looks to me like you're not going to see new lows on the likes of CRV. Pendle is another one that I usually follow. I stake it too. I don't even know where the VTL is. You can't even see the cycle. This is partly the reason I don't like alts. It's like they're so illiquid, I can't even see the cycles. I need to run my model to see where they are. Whereas with Bitcoin, I know where they are. They're prominent. They stand out. But here, it's like, what's happening here? So before the February crash, Pendle from the top was already down. This is the February crash. It's already down 75%, 73. I don't think Bitcoin does 70 in the entire crypto winter sell-off. So that's to answer the question briefly, this is not the time to even, like, I wouldn't even touch altcoins here. Because you might say, hey, great discounts. Zoom out. Great discount on CRV? Yeah, it's down 90%, right? Well, zoom out. This thing hasn't had a bull market in years. So I would stay away. If you already own them, this is not trading advice. I would rotate out of altcoins and concentrate on leading assets. That's what I do. But that's what I do. If I still hold some altcoin bags that I don't want to own anymore, or I really want my money back. Like I don't know. I own some SUI. If I didn't want to hold any more SUI, I do. I think it's gonna Might do you, it might be similar to what Solana did in the last cycle. So Solana had a great start in 2020, 2021, but it really had its really good. I mean, most of the price action appreciation was in 20 and 21. But Solana had a really good bull market in 23, 24, 25. So I'm thinking Sui might be similar, where it's going to have a good, not the best, but a very good, solid bull market in 27, 28, 29. So I don't want to sell Sui, but let's say I did want to sell it because I want to get my money back. You're not going to get your money back by just holding on to Sui, assuming again you're done with it. You're going to maybe get your money back if you sell your Sui and buy ETH, for instance, or you buy Bitcoin. So this is what I do. Usually at the end of a crypto cycle, where at the end of a crypto cycle, you end up holding a bunch of worthless alts. Now, how do you get your money back? Because they're never coming back, those alts. You're never going to get your money back on those alts. Well, one way to do that, to have at least a fighting chance, is to buy things that you know or you suspect are going to have a decent bull market when the cycle turns. And that will be, again, you sell. The classic move is you sell the CRVs, you sell the pendles, and you use the proceeds. You use that money to buy ETH, and hopefully ETH has another decent bull run. Anyways, moving on. So Perry's saying, when you say timing tools, are you referring to macro indicators, Japanese bonds, etc.? When I say timing tools, I mean macro and I mean astro stuff. I mean both. That's why I call them timing tools or timing tools. I should call them forward-looking indicators, but timing tool is a little shorter, so that's what I call them. All right, comments. Interesting summary of the previous crashes. 10 biggest Bitcoin crashes in history. What caused them and what happened next? I'm not going to click on that, but that's a good reference, Perry. Thanks for that. Yeah, 2014. I know that it was Mt. Gox. I know that it was Mt. Gox. But the most devastating exchange collapse in early Bitcoin history occurred in February of 2014. Yeah. But the low of the bear market is in January 15, I think 2015, so it's like a year after that. And in 2014, Bitcoin actually had a great run in the middle of 2014. I don't know what caused that. The price doubled. It was tradable. Like it had a bullish, no, it almost had a bullish breakout of the 80-day cycle, which my model recognizes that as a bullish uptrend. It never quite got there, but it got really close. It would be the equivalent of Bitcoin rallying to 100K now. Like it's almost at the point where you can kind of turn bullish, but couldn't quite cross above. I've noticed that since that bear market in 2014, we haven't really had good rallies during crypto winter. In 2018, we had a few, but they were not great. In 2022, we had none. And it looks like in 2026, we're not going to have any either. Like I think Bitcoin tops out at 80K. That's my intuitions. We're headed to 80. And that's it. And it's like, that's why I say, hey, the fact that we went to neutral it's not really a buy signal, and it's not bullish, it's neutral. That's why it's there. Sandwiched between bull and bear is neutral, zero. It means prices are not going to crash, but it also means prices are not going to have a super strong rally. And this is not the right tool. So if you buy now and you assume 85K, you're going to make 13% after the market went up from the low 23. So you see, most of the move is already done. This is not a time to buy. Way I see it, you're in this trade already or you're not. If you're in, there's hope. We might get 80 to 85K. If you're not in, stay out. Don't get in, especially not now. All right, question. When are you saying our current crypto winter actually started? At the start of the drop immediately at or after the all-time high, or when price action dropped below the latest 48-month VTL? Good question. I actually use them interchangeably. Technically speaking, crypto winter, from a cycle perspective, is the down phase, so from high to low, of a 4-year cycle. So technically, crypto winter started on October 6th. That's the all-time high. That's technically when you should say that's when it started. The problem with October 6th is, well, some people saw it coming, but I didn't. And so for me, yeah, October 6th is technically the start of crypto winter, but I usually sometimes count here, like early November, when prices are at least testing the 320-day cycle low VTL. Because that's when I can see that it has definitely started. So that's a confirmation. You would say technically it starts on the day of the all-time high, but to me it starts when my model confirms it. And my model confirmed it in November. Let's call it mid-November. So moving on. So the 2026 calendar year, January to December, is not a good simple frame of the bear or winter part of this 4-year cycle. No, it's not. I would use cycle indicators. To me, like I said, technically you would say crypto winter is from the all-time high to the bear market low. That would be technically, because that's a down phase of the 4-year cycle. I prefer to use like when my model identified crypto winter, when my model identified the end of crypto winter. We don't have the end for now. We're not going to have it. In case you're curious, my model would say crypto winter is over if we had a crossover above 90, this high here, this 80-day cycle top in late January. So this is partly why I'm saying we're not going to have this. We are not going to see Bitcoin at 6 digits, because if we do, it would say that crypto winter is over. And that would mean crypto winter only lasted 3 months or 4 months. And that's never happened. It's usually 12 months. So I'll be willing to say, okay, maybe we're going to get July might be a low, because notice this is kind of a triple top we have. And July 14th, date of my birthday, that was a great gift. It was an all-time high. So notice that we have very few closes above this July 14th top. And so I don't remember. It was I think it was Eddie. I don't think he's here, but he pointed out, hey, maybe if you count 12 months from a different high, then you can say the crypto winter will end earlier, not in October. I think there's some merit to that. And July is when we first reach above 120K, and Bitcoin sold off immediately. So maybe July could be a crypto winter low. Could be. But I would always count 12 months from whatever the high is. Base case, we get October, because that's the actual all-time high, all-time closing highs in October. But my models kind of, the Astro models are sort of suggesting it could be July. I think some of them are saying August. There are, of course, some of them saying October, but could be earlier now based on liquidity, based on macro. I think it could be earlier. All right, moving on. So comment, maybe BTC only went down 50% because it didn't go up enough previously to the all-time high. And we are at the same level that 70% down would have been. It just so happens to be 50% because of a muted all-time high. So basically what you're saying, Perry, I think if I can paraphrase, is because we didn't go up as much, we're not going to go down as much. This is kind of like a market physics type argument. I agree. Actually, one of the main reasons I think we're not going to have such a brutal bear market is because we didn't have a particularly strong end to the 4-year cycle. It was lackluster. I mean, Bitcoin was down in 2025. That's the first time it's down in the last year of a bull market. Down or flat, sideways, doesn't matter. The pattern remains. And honestly, it's still true. It is mostly true that there's a bit of a markets like to balance themselves. And this is, again, I call it market physics, because there's no reason for this, but this is how it happens. So for instance, gold went up a lot. It went up so much that for that reason alone, you should expect it to go down a lot, because it went up a lot. And yeah, when you look at the fundamentals, that doesn't make a lot of sense. You say, well, why would it do that? Central banks are buying. The petrodollar is dead. Trump is killing the global economy. All reasons why, and countries are looking for a neutral reserve asset. And it looks like gold is going to occupy that position. So that makes a lot of sense. You know what also makes sense that most people miss? Gold has already priced a lot of that in already. And if put a gun to my head, gold under 10K is ridiculously undervalued. So yes, I am saying I think gold goes to $10,000 an ounce. But I cannot ignore these market fundamentals. This is pure price action. Gold went up so much that now I think is going to go down a lot. Just markets balancing themselves. And in Bitcoin, we're seeing the reverse. In Bitcoin, we're seeing the market didn't really move up that much, which is why probably not going to go down that much. We can also point out to we can expand that view and say, well, part of the reason it didn't go up as much is all the institutional involvement. They tend to sell whenever they make money. So they tend to buy lows and sell highs. That compresses volatility. They also tend to use a lot of derivatives. They tend to hedge. They tend to sell calls. They tend to do call spreads and things like that. They need to be hedged. So on the way down, because they're hedged, they're not going to panic sell because they don't have to. They're not going to get liquidated or margin called because they're not dumb enough to have that happen to them. They're institutional, they're professionals. But also they limit their upside systematically. Now, how do I know that? Because I've been trading that way for years. And I learned from these people. So I know how they how they think. They're never going to let 200 at 2x position. They're not going to hold on to that in case they make 10x. They're going to sell. They're going to hedge. They're going to buy puts. They're going to sell calls. They're going to create structures. All of this stuff dampens volatility. It dampens it quite dramatically, and it leads to muted moves. If you want to know what happens when a lot of hedging takes place to a market, let's look at this. Stock market in 2022. Bearish macro, bearish headlines, the war in Ukraine, energy crisis. But the stock market, look at this bear market. This is technically a bear market, not only for my model, but also the classic definition of being down 20%. So 2022 is technically a bear market in the stock market, but notice that it's a horrible time to trade on the short side. There's a lot of rallies. There's not a lot of panic. What's causing this? Well, what's causing this is that in 2020, nobody was hedged, and this is why markets did this. Does this look like a crypto winter, mini crypto winter type move? It's a crashing, never-ending stopping. It's a never-ending margin call. Why? Nobody is holding hedges in 2020. Why? Well, because the stock market was basically ripping higher, had been ripping higher for so long, nobody bothered to hedge. After 2020, everybody held puts. I don't know if you remember, maybe you didn't notice this, but from 2020 to 2022, the VIX was always high in the 20s and the 15s, 15, 20, always high, never went down. That means people didn't fully believe this 20 to 2022 rally. They didn't, 21, sorry. They didn't fully believe, they were always hedged. So when the market turned down and the time came for the bear phase of this cycle, it didn't crash because everybody held puts. So nobody had to sell. People were more tactical. They sold when they wanted to, not when they had to. No forced liquidations. We're seeing that. I mean, we saw that a little bit, these forced liquidations in Bitcoin, because still retail dominated by and large, I think. But the presence of institutions is already starting to be felt. And these guys, they're not going to panic sell. They're going to buy the lows. They're going to sell the highs. So they're getting out of the market around these prices. They're getting in now. Dampens volatility. And all of these, the proliferation of the derivatives, hedging vehicles, instruments, sophisticated structure strategies, those are great for you as an individual investor or trader. But if everybody around you is using the same techniques, that actually kills the trade. Like, it's not as good as it used to be, because we used to trade in the wild west of no hedging, 100x leverage, and people being absolutely stupid with their money, which made Bitcoin do a 20x in 6 months. I think those days are past, because the market is more sophisticated now. That's part of the reason I don't expect all these bankruptcies anymore in crypto, because the people who are in the space now, they're more sophisticated. That being said, I've been hearing rumors that World Liberty Financial is not doing so well. So there's still some scams out there. But, not as prominent. Sandy, good point. I'm institutional, not only ETS, but Sailor wasn't around before either. That's not a question, so I'm going to move on. Comment from Perry. To your point about people getting into bear mode and only shorting, an influencer analyst Dirk has a video literally named "Why I'm Shorting Every Rally Below 102K." Well, there you go. It becomes a self-fulfilling prophecy. I don't think they're going to override the macro, which is promising a decent rally, at least into early May. They're not going to override that, but they're going to make sure this rally sucks. So they're going to make sure we only go a few thousand points higher between now and the actual high, which I will repeat. I don't think it's here. I don't think we're seeing it. I can already point out that if we close here, and I hope we do, if we close unchanged, That's a win. Why is it a win? Because look at this. This is a very short-term price action, but the last two times we went above 70K, we sold off immediately. Immediately. The very next day, Bitcoin was down. Not what happened yesterday. Not what's happening today. We're holding on. We're hanging in there. So I think it's not going to, and these guys are short-term tactical traders. They're going to short. If they don't get any follow-through within 2 days, they're just going to cover their shorts. And Bitcoin is probably going to trigger a mini short squeeze if it goes above 76. So it all hangs on that right now. It's like if we can go above 76, short squeeze, these purely technical people, they're going to cover their shorts. They're probably going to reload their shorts if it goes to 80 or 85K. We're still in bear market mode. So these tactical traders will continue to find entry points on the short side. But I do believe these are not strong hands. These are not convinced positions. These guys are not in like, I'm shorting now because I'm pretty sure it's 76. No, if price action does not accommodate them, because it did the last two times here and here, they were accommodated. They went short. Markets went down immediately. It's not happening for them now. So if we can hang in there here for a couple more days, I'll be pretty confident that, yeah, we're looking at a May 9 top. The top it would not be down. All right, so I caught up. Awesome. So now we're gonna do TradFi. So get your TradFi questions. Oil. All right, so I'll start by saying I've said this before. Oil is probably one of the most manipulated commodities in the planet. And unlike some people, I am not going to use that as an excuse for why I got this or that wrong. I am simply going to say I don't have a strong opinion. And I know for a fact, because I have them, my models, they're good on oil, but they're iffy. They're quite iffy. And the reason I think is there's a lot of manipulation going on in oil. For instance, case in point, let me delete these. These are all, I wouldn't say they didn't work, but these dates, notice that they're all lows. So these are the three key dates that I highlighted in the last AMA from my model, and they're all lows. So this one within 2 days, it's the only one that was off by 2 days, but all of them are lows. So what happened here? Another low. This was a single model using just the declination of I believe it was using the declination of Venus. So it's a single model. I have since improved these models. They're better now. And they have different dates, obviously. But look at this. Delete this. So what is this? This is the middle of the war on March 9. It's just getting started. Oil jumps to $128. And there are rumors that Scott Bessent, who is probably the smoothest operator out of the entire Trump cabinet, the only one who actually knows what they're doing. And the guy is running, this is so funny, he's running the treasury like a hedge fund. And he's shorting oil. These are rumors, but I think it's true, because why did oil sell off so hard here? It made no sense. And the rumor was the US Treasury was selling futures contracts. They were selling WTI futures contracts. And Scott Bessent was called out on this, and he said, hey, because he said you can't deliver, you don't have any oil. And he said, yes, I do. I have the Strategic Petroleum Reserve. So he's running the treasury and the US government like a hedge fund. It's awesome. I mean, guy's a cowboy. I mean, this is incredible what he's doing. I think it worked too. It's scared the living daylight out of people. Look at this crash. The market was very shy after that. I think the same thing might be happening now. And think about it. If you command the entire resources of the US government and you're the treasury, you do have oil. So you could short oil whenever it goes up. It actually makes sense from a trading perspective. You short it whenever it goes up. You're the dominant player, and you have millions of barrels of oil in the Strategic Petroleum Reserve, which you could use to make delivery of these contracts. So people are saying you're naked shorting oil. No, he's not. He does have oil. So what am I going with this? Where am I going with this? Manipulation. There's a lot of manipulation in the price of oil. I mean, the news today is not good to justify oil being down where it is. The Strait of Hormuz is effectively closed now. Trump is not allowing Iran out, and Iran is not allowing anybody else in. So it's like, all right, well, it's a complete landlock in there, or a sea lock. Anyways, completely blockade. There are two blockades on the Strait of Hormuz instead of one. Oil is unchanged on the news. Does that make sense? It makes no sense. You could always say it's a forward-looking indicator. The market is pricing in that the conflict is going to end soon. Yeah, that's fine. But I don't think, I mean, maybe the stock market could be justified in pricing that in, but oil specifically, shouldn't you price in all the disruptions to supply? Arguably, you already are. You could say, well, we started at 65 or 60, we're at 90, we're up 50%. That's enough pricing in of that. Okay, maybe. It could also easily go to 200K, sorry, $200 a barrel if it gets worse. So manipulated market. Now, um, I'm not done, Barry. I'm gonna try and share the models that I have for oil. So let me stop sharing this and let me share this other screen. So let's see what and full disclosure, I don't know what they're saying because I don't trade oil, I don't pay attention to it, but I do have models for oil. So oil is right here. So the cycle that I'm most interested in oil right now is this. This is the actually I'm not going to go to the composite. On a different AMA, I'm going to do a walkthrough of how to use these tools. But for now, let's just stick to let's just bear with me for a second. This is the cycle we're in oil right now. So we're in this cycle. Let me zoom in. We're here. This is where we are. And so we have this low in January, which kind of matches oil. You can see the blue line in this tool. The blue line is what the underlying did. So the blue line in this case is oil. Let me bring it back to chat because I can't see the chat. Where is it? Chat. There we go. Pork bellies too. So Perry, I'm not going to do pork bellies. I definitely don't care about that one. But copper, I should do copper. I don't have it. You can see these are the assets that I have today. I don't have copper. This model is actually pretty good. It has pretty strong correlation. You can see R2 test is non-existent. 37% correlation for this model is pretty good for a short-term cycle, 240-day cycle. Very dominant to explain the price of oil. And you can see that even though it was a little off in saying the low is in January 23, the actual low is in December, according to this trainer. But it's kind of like, this is a good model, is what I'm trying to say. It fits. There are sometimes inversions. You can see them here. You can see how sometimes they can be a little off, where the low is in May, but the forecasted low is in the 10th of June. That's fine. There's a margin of error here, much wider than other models that I've used. They do show a March 10 top. What's interesting on March 10 top is this. Remember that high I was showing you about Scott Bessent shorting oil and interfering with the oil market? That's March 10 as a March 10 top. Then it says oil should proceed lower into a low sometime in May. So mid-May, May 12th. And then from there, oil would proceed higher into a high sometime in July 14th. So let's add those dates. Let's say the 10th of March, let's add the 12th of May. Let's call it the 15th of May, just to round it. And then the 15th of July. Let's see what it says. Because I think it's lining up with Bitcoin cycles pretty well. That's why I wanted to discuss this. So we share back, go back to oil. And you have the first high is March 10. March 10 is right there. You can already see pretty good alignment there. It was a high. I get what you might say, well, it did make, but the high was March 10. It never got higher than that. Then it says, gonna make a low on May 15. Or was it 13? There you go. May 13. Low. So generally speaking, prices from this March 10 top down into a low on the 12th of May. And then the final high would be July 15th. Wrong tool. July 15th for the final top. I'm working on an overlay. I would like to overlay these Astro models on top of TradingView for the sake of doing a presentation, but I haven't done that yet. So, and this would be the outlook. Now, remember what the macro is saying? What is the macro saying? Well, the macro is saying Bitcoin should rally into May and then down into July. What is oil saying? Well, pretty much the opposite. And what do we know about oil and Bitcoin right now? Well, they're inversely correlated. The high in oil should be a low in Bitcoin. The low in oil should be a high in Bitcoin Another high in oil should be a low in Bitcoin. Isn't it saying, isn't that model a mirror image of what we see for Bitcoin? Kind of is, isn't it? So that's all I'm going to do for oil, because there are other models. There are other cycles that I track. They're extremely manipulated. Now what I mean by manipulated is this. So, because I spent some time thinking about this, why is oil so hard to predict? So the reason, for my methods, like, I'm not an oil expert. I'm sure there are other, more mundane methods of like looking at supply and demand, and who's buying, who's selling. That's probably a much better framework to study oil than what I'm using, which is planets and cycles. But what happens with oil is the short-term cycles will move price about as much as a long-term cycle. So what I mean by that is there's a principle of proportionality. Lesson 1, it's on YouTube if you don't know what I'm talking about. Go check that out. The principle of proportionality states this. It states that the longer the cycle, the more prices will move within that cycle. The shorter the cycle, the less prices will move within that cycle. This is true in all markets, and it is true in oil, but not as much. So, for instance, during a short term, this is let's call it a 40-day cycle. Within a 40-day cycle, prices might move by 10 points. And in the longer term cycle, that is 4 times as long, it moves by 15 points. So it moves more, but not much more. So that breaks the principle of proportionality. What does that mean? Well, it means that for my tools, they don't really work so well. That's what it means. It means that when if I'm predicting a big rally on the 18-month cycle for oil, maybe it moves as much as it moved last week, because Saudi Arabia said this and OPEC said that. And so you already had your 15-point move on oil based on just news. That can happen. So the principle of proportionality doesn't really, it's not strong in oil, which makes it very, very, very difficult to forecast. Because normally the way you trade cycles is, with Bitcoin, for instance, you want to trade the 4-year cycle. Then within that, you're studying the 11-month cycle. And within that, you're studying a 20 or an 80-day cycle. And you're trying to use that confluence of cycles to pick the 4-year cycle low. If you do that with oil, you're not going to make a lot of money. You're much better off. You're much better served trading short-term swings. You make a lot more money that way. And it breaks the models. Because what looks like a big move on a, say, 18-month cycle is not really a big move. It barely moved more than during the last 40-day cycle. So it makes it very hard to predict, which is why with oil specifically, I just look at this 240-day cycle. I don't care about any others, because the timing of these highs and lows on that one 240-day cycle, they fit what I think will happen and what the macro is showing. They fit it perfectly. Can I show this? Let's see. There we go. And this is since this is a TradFi asset, this is 60 days. There we go. Okay, perfect. You see what I'm talking about? So oil is kind of following the inverse of liquidity. It moves in reverse to liquidity, and it's kind of showing the same thing. So you zoom in and you go, okay, we have the March 10 top. It doesn't really show up as a top, but you could argue it's here, right? By the way, there's a very loose correlation between liquidity and oil, but it is there. So you can kind of see these 3 points that I'm highlighting already in the macro. You have this low, that's this top. You have this high, it will be this low. And then you have the next, so you have this high in liquidity, it will be this low in the price of oil. Some people like Luke Groman have spoken to this inverse relationship between liquidity and oil. If you want to check out their work, it's pretty good. Michael Howell also speaks to this. He always says the price of oil begins to rally, it sucks up liquidity. So that's what creates this inverse relationship. And then we have this upcoming high in oil, which is a low in liquidity, June, July. I keep saying June, July, because in some models I see July, in some models I see late June. So this is the outlook for oil. We are not done. This is just a pause. And you can see that consistently across all models, that we're seeing a pause. This is not the end of the war. This is not the end of geopolitical chaos. We're in the intermission. The intermission is now, and I fear the intermission is going to end soon. Late April, early May at the latest. In fact, if I look at the astrology, strictly speaking, I forget markets, I just look at the astro cycles. it looks to me that the end of the ceasefire on April 20 is when all hell breaks loose again. That said, I do think that eventually they're just gonna exchange punches again for a few more months, and then it will end. That's at least my hope. I hope that's what happens. All right. So Perry's saying it looked like on your other cycle model that the blue cycle consistently led the reddish cycle, front running it. No, not really. Let me actually did some work on that. It's more like it's more, think of these imagine if these two, let's just accept the fact that planets for a bit, suspend disbelief, and just assume that it is true planets do correlate to events here on Earth. Let's just accept that. Let's just not question that for the sake of this discussion. Um, one of them is not causing another. In fact, I actually did that work. Some of these models, they tried to see if there's an offset between the planet and the event. So the planet and the cycle. There is none. These things work in real time. So whenever the Venus thing is doing whatever it's doing, that's when you should expect the high or the low. Ina, who's here, awesome trader, awesome astro trader, he will speak to this too. I don't think he's applying any offsets to the forecast. So astrology works in real time. These planetary configurations, they work in real time, but they are synchronous. I do not believe that the movement of some planet is causing the price of oil to do this or that. Rather, I think what we're seeing is it's called synchronicity. So synchronous events. That movement, as detached as it seems from events on Earth, they're not actually detached. They are synchronous. By that, what I mean is there is a slight offset. It's like they're doing this. So it's like you're studying the same movement, but it's not perfect. So Perry, to answer your question, sometimes the orange line is going to lead the blue line, and sometimes the blue line is going to lead the orange line. It goes back and forth. Now, why am I saying that? Because I observed the same thing, and I said, I wonder if there's an optimal offset. Like I should take this oil model and push it forward or backwards by 10, 15, 20 days. Nope, there's nothing to it. You shouldn't do that because this offset varies. So sometimes the planets will lead oil, sometimes oil will lead the planets. It's almost as if you're looking, like I said, at synchronous events, things that happen to line up. But you should study them, and they're correlated, but they're not perfectly aligned. To be perfectly honest, the models that have 90% correlation, they're long-term models where the top is such a long, or the bottom, the turning point is such a long, drawn-out affair that, yeah, it just so happens that the correlations look pretty strong. But if you actually want to have the exact date of the high or the low, there is a margin of error there. So yeah. Anyways, let's move on. That's just enough of that. I hope you like the tool because the tool is awesome. I can promise you this tool is amazing. Because yeah, it's not as good as macro, but I don't think there's a macro tool that leads every single asset on Earth. And yet this framework for using planetary motion to forecast any asset, it works on any asset. I can run it on Tesla, I can run it on Nvidia, the Chinese stock market, the number of seats that Democrats and Republicans occupy on Congress, anything, an inflation time series. I can run it on liquidity itself. I can run it on anything. I can run it on any time series, and I can find the correlation if there is any. If there are no correlations, the model would say exactly that. It will say no correlation. I have not seen that yet, but I'm guessing it's possible. So what I mean by that is, while it's not as strong as macro, it's not. I don't have such a solid macro framework to predict gold or oil or copper or the Chinese stock market. I don't know what macro factors drive those assets, but I can run this planetary thing on anything. And I've had amazing results. All right, back to chat. So did you cover gold? No, I have not. Let's go to gold. Gold. All right, so gold, I'll say this. Again, I do not have any macro tools to forecast gold. Some people think it's liquidity. Michael Howell is in that camp. No offense to him. I mean, he's using proprietary indicators. I don't have access to those. The liquidity indicators that I have do not show any predicted power over gold. What I mean by that is Japanese M2, global M2, none of these things forecast gold. Now, again, I don't have access to Michael's proprietary liquidity models. I don't. He keeps them to himself, of course, as he should. So the macro indicators, the liquidity indicators that I use do not predict gold. So I'm not saying there's nothing there, but I don't have access, nor have I found those tools. So that's number one. I wish I did. I thought for a while that I did, but then I actually did the math and it didn't work. It broke down. So if it doesn't hold up to if the math doesn't show up, doesn't show the correlation, like if you do the proper statistical analysis and it doesn't show the correlation, then I drop it. I stop using it. So I thought M2, global M2 let gold. It doesn't. I thought maybe central bank liquidity. It doesn't. 10-year rates. 10-year rates I haven't tried. Actually, maybe that one does. But yeah, I have not found a solid macro framework for gold. When it comes to cycles, to the planetary stuff, the stuff that I have, Perry, on Discord, I think you and I can both agree it's not great. It's kind of loosely there, but it's not great. I was not happy. I was never happy with how those models performed. I call it the aspect model now because it looks strictly at dates when a lot of aspects that in the past have caused turning points of volatility in gold, and I project those forward. That's an aspect model now. It's okay. Yeah, it works sometimes. Sometimes it doesn't. The new models are actually very good for gold, but I have not calibrated them because still gold for some reason is not easy to forecast. Even though this new framework is very good and it does predict gold. You won't be shocked to hear it still says that the high of many years probably took place here. Now, why am I saying that? Because the actual ideal top, according to the long-term cycle models, I'm going to show you those in a second, was in late 25, I think, December 25 is the ideal time for a 3.5-year cycle high on gold. We're overdue. And the price action, like I've been saying for months, is very indicative of a long-term top. And I know I'm extremely contrarian in saying this. And I hear those arguments, central banks, the end of the petrodollar. Yeah, I hear all those arguments. I agree with them. But I also have to relate what my models are saying. My models are saying this thing is done. This thing is done. We're not, it may be that we don't go a lot lower. Maybe we go to 4K, maybe 3600. So I'm not saying it's going to crash or anything. I'm just saying that when I say it's done going up. That's what I mean. Like it's not going to rally anytime soon. No, we're not going to $6,000 gold next month. We're not going to do that. As much as I've calibrated and recalibrated and tried to fine tune the gold models, I have never had a model that actually suggests gold will continue to go up. I don't see it anywhere, which is why I'm consistently saying this is it for a while. And I mean several months, probably 26, probably longer than 26. You're not going to see new highs in gold. That's what my models are saying. Don't shoot the messenger. If I happen to be wrong, okay. But that's what my framework is saying. Now, let me share that framework because there are some interesting things here that I found the other day. So let's load that up again and let's go to gold. First of all, let's go to gold weekly, which is not something that I use too much, but this is the gold weekly long-term model. And as you can see, it has a 90. So the training, oh no, this is training. So again, it doesn't predict price, but 81% correlation to golds. I believe this is the 14-year, or I don't know, maybe the 7 year. This is probably the 7-year cycle in gold. And so this is the training. This is the training period. Here, if you go into the past, this is the testing period. And even though the model is not perfect, even the trainer here has this weird thing here. Even so, it has the high for March 2025. And it shows a consistent decline going to 2030. So that's gold weekly. Not the one I use mostly. You can see that these models are not great, but this one is. Just so you know, the color coding here, red means it's not great, the model. Yellow means it's okay-ish. You can use it. You can probably use it, but you should use it you should confirm with other green models. We have 2 green models here, but when you have purple, that means it's over 80%, I think, or 70% correlated. These are very strong models. And notice that in the case of gold, the strongest model we have for the weekly price of gold is saying that the high is in. So there's that. But I haven't run this in a while, to be honest. This is an early run, an early version of this model. The gold daily chart, it is running on the latest version of the model. It's saying the same thing. So you can see here that the long-term model peaks in November 24. That rhymes with March. So again, it peaks here. These long-term models, again, I haven't calibrated them. I think the good ones, this one says August 25 for a top. There's a multi-month margin of error on these multi-year cycles. So these are all lining up, actually. The fact that it says November 24 through April 25, and that the other one is saying August 25, they're lining up because this is well within what you would expect the margin of error to be. Then I actually use this one. This is actually much better. This is a 3.5-year cycle, which I don't teach on the lesson because I didn't find this when I faced it manually. The reason I have these cycles now is I'm using phasing a spectral analysis to find cycles now, which is much more robust. And it finds frequencies that you don't see with the naked eye, but they're there very consistently. So there's also a 3.5-year cycle in gold. And this 3.5-year cycle in gold, this model is, again, you can see here that it's a composite model, but it's based on 3 solid models. This correlation you can ignore because it's fake. I don't know where it gets this from. I'm going to ask the AI, hey, where does this come from? But the models are pretty solid. 91% correlation, 76% correlation, 82% correlation. You combine these and you have a unified outlook. Since this is a composite model, you need to take these range of dates as a potential high on this 3.5-year cycle. And what does it say? Well, it says December 2024 through April 2025 again, and the low would be in 2027, March of 2027. Strong model, agrees with all the other models. You can see, without exception, all of these long-term models, 7-year, 14-year, 3.5-year, all saying the high is 2025, late 2024. That's what they're saying consistently. The price action is quite, what's the term I'm looking for here? It tracks. The price action tracks with these forecasts. Why? Because there is a wide margin of error here. Look at this model, for instance. It's saying that gold should actually nail this. But if you go back, remember that 2015 low on gold? Here, it shows up on April of 2014. So these models, these models that track these long-term frequency, they begin to move ahead of price. And gold might bottom out later than suggested by these models. That's why you have to use the shorter term stuff. If you want to fine tune the date, you use the short term models. But if you're going to get a big picture of what gold should be doing over the next few years, this is when you use these long term models. This low here for April 2014, the actual low, December 2015, much later. But it still tracks. So it still rhymes, is what I'm trying to say. I can't do the whole overlay here because I can't do that yet. But let me see if I can go to the visual and I can show you how these work. Notice that sometimes they line up perfectly, such as this October 2020 top. It actually happened in January of 2021. This is well within the margin of error. But sometimes the model is going to turn on, again, June 2018. The actual low is in February 19. It's much later. So the fact that it's saying now, and for instance here, it showed February 2022. Actually, this is not true. The low is actually when the model says, which is November 2022. So October 2022 is the low. So the fact that now it's saying, hey, the high is in November 24 through April 25, that tracks with a late 25, early 26 high. So, okay, enough of that. I think you get the point. The model is bearish right now. The one that I use the most is the 18-month cycle. And it's very interesting, this model. Let's see. Is it this one? I believe so. It's a composite model, I think. Oh yeah, it's a composite model. So this is pretty interesting. So short term. Now we're looking at the 18-month frequency for gold. And it said that that there should be a low sometime in December of 2024. All right. Then in 2025, it has 2 dates, basically April, mid-April, and I believe early August. What does it show for gold between April and August? It shows a pause. So gold going sideways. Then we fast forward, and this is where it begins to get interesting. It shows a high for March of 2026. I believe gold inverted on this date, on March of 2026, March of this year. I believe it inverted. If true, then March shows up as a low in price action, which means prices are likely to rally into a high in June, followed by a pretty severe correction into November, I think it was. Yeah, November, early November, late October of 2026, of this year. Meaning the outlook that I have for gold now is for prices to stay range bound into June, and from June through November, probably going to have another leg lower. But I should say, I'm basing this on the assumption that this March high is actually a low. Now, let me show you the price action because this is actually quite remarkable. Remember this, December for the low, then we begin a rally. It ends in April. The rally resumes in August, and we have a high sometime in March. So now let me show you gold. And this is it for gold because I think the shorter term models are a waste of our time. It just doesn't matter. Like unless you're trading every swing in gold, it doesn't matter. So this is long term. This is the investor presentation for gold. Now look at this. This is incredible. Let's ignore what happened before because according to this forecast I just showed you, a new cycle begun in December of 2024. This cycle is scheduled to end in November. So here it is. Here's December 2024. You have this. This is when the run started. And I'm not making this up because I just showed you April. This is the high. This is the April high that I just showed you in the forecast. Then early August. Early August is right there. This is early August. This is when the run begins. So far, so good. It's following, gold is following the forecast. But then we get to this. When is the high? Well, the high is in January. And this could be the March top. This could be the March top, I will say. If so, then gold is going to make a spectacular high going into November. In fact, one of the key takeaways here is if this January top in gold is the March high that is shown in the forecasting model, then you should expect a low in June and a blow off top into November. So spectacular blow off top into where's November? Into November. That's a possibility. But gold made a low, and it looks like a pretty significant low on March 26th. What was the date we had? March 30th. The model is likely inverted. This is what I mean by when I say I don't rely mainly on the Astro stuff because they invert. It seems to me that this March high turned out to be a low, which means the model flipped. It's now inverted, which means when you go back to those forecasts, you need to view every high as a low and every low as a high. If true, then we have this March low, March 30th low. Then we have the mid-June, let's call it mid-June high, and then we're heading down into a low in November. So instead of a high, we get a low. Delete that, and this is my base case. So gold will remain strong for now, somewhat strong. Makes a top in June, should be a lower top. That's your tell, by the way, if you're wondering, hey, how can I tell if this is inverted or not? Well, notice the all-time high. If the model is inverted, gold will stay below the all-time high. If gold breaks above on a weekly closing basis, if it closes above the all-time high, then it's not inverted, which means the final top is in November. Not my base case, because I think it's done. It's trading like an asset that does not want to do anything. So this is my base case, is we have this. And then the final low is in November. I'm looking to buy in November. So that's the outlook for gold. It's, again, it can flip. It can be the opposite. If it is the opposite, then you just flip everything. You do this. See, this is why, as fascinating as the Astro is, you can never get away from this. This is what we have. The timing, I'm pretty confident of. The direction, not so confident. but I'm pretty sure it flipped. Why am I saying that? I don't have time to show you here, but I went through model after model after model, and guess what? I cannot find this January top. I don't see it. Typically, when the models invert, it's because an important turning point took place and you didn't have it. And it causes everything to flip, because I've seen this with Bitcoin. So the fact that I don't really see this January top leads me to think that all the models are now inverted. Again, these inversions, they're annoying, but there's a logic behind them. They're not totally random. Usually a big turning point takes place, which you didn't see, and that flips everything negative or positive, depending on which asset you're looking at. All right. So, question: silver, my personal favorite, still just follows gold, correct? Yes, actually, Perry, and I knew you were going to ask about silver, and I have my answer is I have not done the forecast on silver yet because I think it's a waste of time, to be honest. The timing is the same. It does the same thing. I'm curious though, maybe I'll run them because I'm at the point now where I'm polishing the model and adding more assets. Just spending time doing that. So fixing bugs, polishing the model, and adding more assets slowly. So eventually you're going to be able to see silver in there. But for now, I would say, yeah, it just follows gold. I gave you a pretty, I wouldn't say it's super bearish gold. I think it's a buying opportunity in November, probably. I'm going to take it. And silver's just going to follow that. Whatever gold does, it will follow that. All right, moving on. So it looked like your other cycle model that the blue cycle consistently led. Oh, I just read that already. Let's see what else. Stock market. Let's do the stock market. Boom. Delete everything. Stock market is at all-time highs. Great, but not Bitcoin. I hate that. Stock market is some. I know you didn't technically, Perry. I don't know if you asked me about the stock market. I will say though, I think we need to review the stock market because I'm gonna be either extremely right or extremely wrong in what I'm gonna say next. And I think I call bullshit on this rally. I call bullshit on this rally. I don't think this is it. I think the market is running on hopium. And I don't want to sound like one of those perma bears. I mean, I know a lot of perma bears. They're always saying, oh, it's hopium, it's fake, it's not real. I'm not one of those. I actually trade on the long side of the stock market. I am not buying this rally. Actually, I'm getting ready to short. Part of the reason is in lesson 4 on YouTube. Please watch that. It's actually one of the best lessons in the entire course. Why? Because I've traded the stock market for 15 years. And for that reason, I know it very well. And so I know which cycles work. I know which cycles don't work. I've done a lot of manual work on the stock market, just like I have on Bitcoin, to the point where I can give you a more curated analysis, a more tactile. I have a more tactile feel for the stock market. Whereas if you ask me about oil, I'm just going on what my models are saying. I'm not going on anything else. My models are saying this, I relate that to you. When it comes to the stock market or Bitcoin, I have more of an opinion because I've traded it for long enough to, I think I deserve to have an opinion. I've earned the right to have an opinion on these. And the stock market to me has crossed the first bearish threshold, which is right here, lesson 4 on YouTube. Please, again, it is one of the best lessons. Why? Because the stock market is amazingly simple to study, to predict. It is amazingly simple. All you have to do is track the 20-week cycle. You track the 20-week cycle, you get all the other cycles as a derivative of that. So all the other cycles, they dance around this 20-week cycle. So I love it for that reason. And the only other asset that behaves the same way is Bitcoin. Bitcoin, every single cycle behaves or revolves around this 80-day component. The 80-day component is the 20-week component in the stock market. And the stock market, I would say, is even easier to predict. Because it has this thing called positive drift, it tends to go up, which means every time you forecast a low in the stock market, they're all buyable. You can buy every single low in the stock market, whether you're in a bear market or not. It doesn't really matter. You're going to have a 15% move no matter what's happening because the stock market leans bullish. Stock market investors lean bullish. There's a lot of institutions which just buy stocks. So that's why you lean bullish on the stock. This is all to say, I'm not a perma bear, and I'm not one of those guys who say, oh, the big one is coming. No, there's no big one coming. But I do believe the stock market is about to wake up to reality. And I'm not just saying that lightly, and I don't always say that. So first threshold has been crossed. Again, lesson 4 on YouTube. It's this double VTL rule where you can have 2 consecutive breaks of the 20-week cycle, low VTLs. So in other words, the way the stock market is trading, to me, as soon as we break this low, this horizontal level here, let's make this solid and orange. As long as we break this, you can short it. Breaks that, you can short it. You can use the VTL if you want, but as I teach on lesson 4, if the VTL has a downslope, you can replace for the horizontal level. So the stock market looks to me like it's about to do this. Has that happened before? Actually, many times. I've seen many tops that look like this, where the stock market rallies to a yield. It's a head and shoulders pattern. It's kind of a derivative of that. So it's a head and shoulders pattern where, yeah, it goes to an all-time high, but the cycle really ended on this October, because actually I have October top. So it ended here. So sometime in here, we have a long-term top. And I could be wrong, but it looks to me like it's starting to shape up, that this pattern of topping up, of having these 2 consecutive crossovers, is starting to line up. So with that being said, let's look at the forecasts. And the forecasts are here, SPX. I have the NASDAQ too, and I am pleased to say the NASDAQ and the S&P 500, they say the same thing. So let's focus on the SPX. And here we're talking about this cycle. We're talking about, let's go to individual. This is probably going to be better because you can see the trainer. So we're talking about this 20-week cycle, which according to the spectral analysis is running on 120 days. Normally it's 160, I think, but it's running on 120. So 120 days, 160 days, doesn't matter. It's the same cycle. And what does it say? Well, it says, let's see, December 25, we have a high in February 13. We have a low on March 16. We actually got these 2 already. We even have this low, I think, November, December 25. Then it says we're going to rally into a high in May. May, June. You can already see how it rhymes with liquidity, with Bitcoin. We have these highs in May. So the stock market agrees. 31st of May, high in the stock market. The low, the 16th, actually took place on the 30th, not on the 16th. That's fine. Then it says there's a low in July. Again, the low in July. That also shows up in liquidity, and it also shows up in Bitcoin. So this is the short-term outlook. So we already had this high in February. We had this high in March. We're going to probably have a high, let's call it June, let's call it late May. And from there, I believe that the tradable portion of this down cycle takes place between May and July. Again, you need price action confirmation for this, but this is what it's shaping up to be. It's shaping up. It's looking like June, July is when you want to short the stock market. But why am I saying that? I'm saying that because here's the 18-month forecast for the stock market. And by the way, these 2, this is a 4.5-year cycle. The 4.5-year cycle, 1640 days. I found this cycle using spectral analysis, using data from 1975 through 2025, and Hearst using data between, 19th century through 1971, found the same cycle. It's 4.5 years, and I found it too. What does it say? Well, you can see here that the statistics are robust. It's a 98% correlation. 98% correlation. So this is a very strong model. When this model turns, you have to pay attention because there's a 98% chance the stock market follows it. Now, I don't have time to drill into this. Sometimes the corrections highlighted by this model are just sideways. So the market just goes sideways. I believe 2018 is an example of that. You can see here that how the model turns down between December 17 and a final low in November 19. We got that actually, but it's a sideways correction. So you can't short, really, meaning you need price action confirmation. So I hope that made sense. There's a 98% correlation between this 4.5-year cycle and the price of Bitcoin and the price of the stock market. But sometimes these corrections are sideways. So you can't trade all of them. You have to trade when you confirm via the price action, meaning sometimes the stock market does go down in these time periods. Sometimes it just does this. All right. So price action confirmation, very much needed. That said, this model There's probably one of the strongest, if not the strongest model that I have in the entire work that I've done with these cycles. 98% correlation, 46% turning point accuracy. I don't have time to discuss that. I will do that some other time. Suffice to say, this is a very, very strong model. The best part, look at this. Features, 1 out of 80. This is a single causation model. This has one feature. I don't remember which one it was. I believe we're looking at the midpoint. So this cycle that you're looking at here, I could be wrong, but I think it's Saturn-Jupiter. This is just a Saturn-Jupiter cycle. And for any of you mundane astrologers out there, it is widely believed that this 20-year cycle is actually what explains the cycles in the economy. I believe this one model is just looking at that, Saturn-Jupiter. Could be wrong. I'll get back to you on that if you want to know exactly what causes it. I don't care personally. That's why I don't look at it. I know it has a 98% correlation, and it's a single thing. So we're looking at we're looking at either a pair of planets or a single planet as it moves through the zodiac here. It's remarkable that it has a 98% correlation. This is not random, guys. This doesn't happen. You don't get 98% correlation randomly. It's just, you don't get it. Anyways, and it's turning down. So it says that the ideal high is between November 2024 and May of 2025. You can see how we're long past that, and we don't really have a high then. That's normal. The long-term cycle is bearish between now and late 2026. So not a lot. Like, again, not predicting the end of the world. I'm not saying doom is coming. I'm saying, hey, I think there's a sell-off coming in the stock market. I don't think we're done. I think there's going to be another leg down, and that one's going to be a lot more tradable than the one we just got. Because right now we're running on hopium. What happens when hopium breaks? Market crashes. People sell. They panic. There's a lot of confidence right now that the war is over. I don't think it is. All right, so moving on. 18-month cycle. The 18-month cycle has 86% correlation. Now we're using 80 features. So how do I get this sine wave? 80 things. And I don't know what they are. I will say, though, usually it's dominated by just 2 or 3. And then the other 75 add color and context. That's how they work. We don't have to ignore that. We have a high in November. So now we're fine-tuning. This is how you do this, by the way. Again, we'll probably, if you guys want, if you don't, then fine. I'll give you this tool. You can use it. I highly recommend we do like a workshop, an AMA just on this, where you ask questions on this, because you need to learn how to use this. So first you start with the long-term cycles to form your long-term outlook, and then you start getting shorter term. All right, so you start here. We already know this is bearish. All right, what about the next cycle? Next cycle, oh, it's also bearish. Okay, but what about the dates? Well, the dates are between October and November. Now we're getting closer to the real top, because the real top was, I think, February. I think, or December, I don't remember. And it's saying November 26th. Okay, so November 26th, that actually rhymes. This says October. But it does concede when you see them go flat like these, it's a range of dates. That's why I don't know if you see them. It's too dark, but you can see these potential turning points here. So you have September 26, you have January 27, and you have March 27. So these range of dates. All right. So then you look at the shorter term. Okay, so November. Well, it looks like November. It's not going to be 27. It's going to be 26. Shorter term. That actually tracks with the 4-year cycle and liquidity and whatever, which is scheduled to end in late 26. So this tracks. This is looking good. The only one that stands out to me as not confirming any of this is this model. Actually, it says there's a high in November, but it puts the low in June. This makes no sense. I believe this model is inverted. This is the weakest of all models. It's 41% correlation. It's actually the weakest. I don't put a lot of faith on this one. So the way I do it is I go here, 4.5 years, 18 months, 20 weeks. You notice if you watch lesson 4, I don't talk about this 40-week cycle. I found it on spectral analysis. The correlation is definitely strong. So I have it here, but I will say it's kind of an odd one out. It's saying, yeah, the high's in November, but the stock market should sell off continuously into June. It's already not happening. So this is probably inverted because the next turning point is November. So if we assume this model, this 40-week cycle model is inverted, then it's actually lining up surprisingly well. We have early June for the top. We have November for the low. What about the next cycle? What I just showed you. The next cycle, it says February high. That actually is the high. So you see how you go short term, yeah, it's wheels within wheels. So you start with the big picture, you drill down into the shorter term picture. Personally, I would not go shorter than 120 days. The 40-day cycle is good for a 40-day cycle, but I haven't looked at it enough. This is for short-term traders, not for me. All right, so now we have, where is the high? Well, the high is, according to this, in February. I think the high is in February or December. So we're getting close to the actual thing that happened. So our outlook is bearish. All our models are bearish, with the exception of one, which is likely inverted because it disagrees with all the others. That's why. Also, there's no way, based on how the stock market is behaving today, there's no way we're going to get a low in June. There's just no way. It's not going to happen. It takes months, weeks for the market to roll over. We're at all-time highs. We're not going to get to a big bottom in June. It's just not going to happen. That's how you can tell this model is inverted. Beyond that, look at this. We have the same date, late May, early June, but it shows a high, not a low. And I will say stronger correlation. This is 41%. This is 61%. Much better. And it's showing a high. So again, the weakest of all these models in the stock market is this one, the 240. That's likely because that cycle doesn't really show up in price action much. If you just do phasing analysis using the methods that I teach in the course on YouTube, you're not going to find this cycle. This cycle is more of it's a frequency that is there, but you only find it when you do spectral analysis. Just like there is, I've touched on this before, there's a 40-day cycle on Bitcoin. You rarely see it. You see it sometimes and you don't. That's the 240 on the stock market. You see it, then you don't. So I don't pay much attention to it. And now we have, ignoring this one, which again, I think is flipped, inverted, high in May, low in July, and we do have November as a low. So if this sell-off that's coming is worse than I think, we may get a low in July, then a bounce into October with another leg down in November. Personally, I think the bottom is going to be in July. So it's going to be here. So it's going to be this very brief June through mid-July window. That's it. That's what you're going to get if you're a bear. You're going to get 2 months. But price action has to confirm. So that is the stock market outlook. By the way, I did this because I actually prepared for this one. The NDX says the same thing. So all the model, it has the same cycles. It says it has the same turning points. Like it's within a few weeks. So the outlook is exactly the same. Anyways, going back to this. Hopefully I didn't miss anything. So comment, Perry, the inversion and the astro cycles reminds me of Choose Your Own Adventure books. Where one choice then changes everything in the story. Yeah, the way inversion works, Perry, is basically this. Once you notice the inversion, just assume that everything will be inverted until you see the inversion again. That's how you work with this. But yeah, it's kind of weird because it plays with your mind. So because it makes you inversions for a non-cycle analyst. They kind of they're annoying because you go from being bullish to bearish. Oh, it flipped. Now I'm bearish. Oh, it flipped again. Now I'm bullish. So it's kind of like schizophrenic, but it actually works. There's a logic to it. Actually, Bitcoin recently flipped also. But I don't know if we have time for that. So do you ever analyze cycles by first dividing values by inflation? No, not really. I subtract one cycle from another. That's what I do. In other words, the stock market values might be up in numerical value, but not actually if each value is adjusted by the ridiculous new supply of money that's been printed. Money printer go burr. During the same time, yeah. So that's what I meant when cycles going sideways. So for instance, if you go to the long-term cycle in the stock market and you isolate the 4.5-year frequency, what you have is that this is a 4-year cycle correction. So this expanding triangle, because that's what it is, a very annoying pattern. This whole period that started in 2018 is identified as a 4.5-year cycle correction. So when you do spectral analysis, this shows up as a cycle sell-off. So I guess if you adjust it by inflation or the supply of money, you would see this as a down period. You would see this. You would probably see this. But if you do spectral analysis, in other words, if you have these, they're called bandpass filters. So if you isolate the frequency, inflation cannot hide that. So you see the frequency, you see it, you can still get it, and run forecasts on it. So suggestion: run your astrocycle analysis on empires such as the U.S. Yeah, well, I need a binary indicator for that. I need something that goes up or down, and so I've thought of doing that. But what goes up and down that tracks an empire? Like I thought of running this model with people. Like you give me your birth date and I run the forecasting model on you. But the problem is I need a binary indicator for you. So how do you do that? What line goes up and down with you? Like the thing about stock prices is that they go up and down and they're a sine wave and you can correlate. But if you run an empire, like what is that? Public debt, number of US bases across the world. Maybe there's a sine wave there, like number of bases as a proxy for US presence in the world. Maybe. Yeah, you go from 0 to whatever, however many they have now. That could be. I'm going to do that at some point. Like I'm going to forecast other things for fun. But yeah, not now. I'm still building the model. This is not a finished product, by the way. And I think you'll agree it's pretty good. But yeah. Suggestion: build into your astrocycle visualizer a way to designate inversion periods, maybe background color changes or similar. I've done that actually. Let me share again. I have done that. I haven't really done that. I try to do that with the correlation line, and when it goes negative, it flips the color or something. I've been thinking along those lines, but it doesn't really work. Like it's more annoying than it helps. Like it's annoying. It's just too much stuff. I think it's much better to just, for now, like I do want to do that. I want to study if there's any pattern to inversions, mostly. Like a way to forecast an inversion would be gold for this type of analysis. It would be extremely useful to know ahead of time when to expect an inversion. But yeah, I'm not there yet. If I add too many features, none of them work. So I'm trying to focus on the 3 things that I'm doing now, making sure they work, so that then I can expand outward from there. And I'm trying to cover more assets. I'm trying to give you guys more things. Everybody, even at WISE, we have a. By the way, anybody who wants to come to the WISE conference, it's between May 3 and 4, May 2 and 4, I think. You can look it up in the WISE Ratings website. We can catch up there if you want. I'm going to do a more proper presentation of that. Then I'm hoping for a 2-hour speaking slot. I don't know if I'm going to get it, but I want it to be just about the tool. And that's when I'm going to collect feedback for the first time. Like anything from is the color palette good? Do you like that dark tone? Should I add a light tone? Should I keep the composite models or should I just keep the individual view? Correlations, trying to forecast inversions. These are all things on the pipeline. I don't know if there's any pattern to inversions, though. I just don't know. So yeah, that's I think I've been doing this for 3 hours now. Considering I've been sleep deprived.
Juan, I think also building a dashboard, what we were discussing earlier, that would be
Oh
very.
yeah, no, the dashboard is coming. The dashboard is coming.
Yeah, we'll talk about that on Friday, but yeah.
Yeah, we'll talk about that on Friday. So the dashboard, just Sandeep mentioned that here. What I have in mind already is there's going to be another tab where you're going to be able to say, hey, I want to know what's going to happen this month on cycles that are longer than this frequency. So you're going to say, for instance, by default, it's going to be cycles that are longer than 80 days. So then you go to April, or your April calendar, your May calendar, and it says, hey, in May you have a whatever. You have a 480-day cycle high on gold. You also have a 120-day cycle low on oil, and that focuses your attention. So the idea is for somebody who wants to trade multi-assets. Why? Because I want to start trading multi-assets. I want to start trading multiple things, not just crypto. So I want to create a dashboard that kind of focuses my attention because I'm going to continue to trade crypto day in, day out, following every cycle. I'm going to continue to do that. But if I see a rally in oil, notice that my model picked it up, I would like to trade that. If the stock market is about to crash, I would like to trade that. If gold is about to go parabolic, I'd like to trade that. For instance, I don't know if you noticed, but the 18-month cycle forecast for gold predicted remarkably, it predicted this. Like what it predicted this. It said when this chop would start and it said when this chop would end. I had gold and I sold it here. If I had the model, I would have bought again here. So I'd like to know that type of stuff. So that's the dashboard. So yeah, I'm gonna call it. Thanks everybody for joining. I didn't lose that many of you, so shout out to you guys. I mean, thank you for sticking around for 3 hours. I know I don't have time for that, but
Hey, Ina, I
yeah.
know you were there. I just want to say thank you the other day. What you posted on Discord, it was very valuable. I don't know you personally, but your input was very valuable. So thank you.
Yeah, keep doing that, Ina. Please.
Yeah,
Your
we
input
really
is
appreciate
really
that.
valuable. Yeah. He's good. I met him, her. I don't know. I don't want to. Yeah, I don't know what the term is, but I um I um I saw your post on Twitter. I was like, hey, this is pretty impressive. So thank you for joining the group, and please keep sharing your insights with everybody because, yeah, we benefit by sharing what we know together. When you share that April 7 turning point that you had, that's when I went, hey, I know that date. Oh, I know Japanese liquidity. So that was invaluable. That was invaluable. Just the fact that you highlighted that because I was still, I was prior to you sharing that April 7 turning point, I was thinking, hey, my liquidity thing broke. It just broke. I can't use it anymore. And then you said, hey, I have April 7. And I was like, oh, wait a minute, April 7. That sounds familiar. Oh, yeah, I know that. I've been looking at this Japanese M2 and it has April 7 right there. And that was when Bitcoin started running. So, anyways, with that, I'm gonna go, and I'll see you all on Discord. I'll share the recording when I have it, and you're also gonna find snippets of these videos. You're gonna find the full thing on YouTube because I don't think I did anything incriminatory this time. There was the one AMA that I didn't put it online because I said some bad things about Ripple, but I'm not gonna repeat them here. So this will be on YouTube, the full thing, and also split into a gazillion videos for your viewing pleasure. And yeah, thanks for joining, and I'll see you all. I'll see you all in the next one. Cheers.